My name is Jim Hopper. I'm the executive director of Bainbridge Community Foundation. So if you are not local to Bainbridge Island is a little community about 8 miles off the coast of Seattle, and we're about a 35-minute ferry ride from Seattle. The community is rich in cultural history, from strawberry fields to boat building, and many places and activities in between. The Community Foundation's mission is to enhance the quality of life of all people who live on Bainbridge Island, who work on Bainbridge Island, and who visit Bainbridge Island. And so we have a broad mission to help serve the community. So you might ask, those of you who are joining us from far afield, what is a little community foundation in the Pacific Northwest doing to sponsor an event like this that has a national audience? And I will put it all squarely in the hands of Paul Merriman for something like that. He is an island resident. He has served on the board of the Community Foundation, and he has really brought his passion to the forefront. All of you have community foundations that serve your community. They may serve your local community. They may serve your state community. But we encourage you to get to know your community foundation and see what you can do to be a part of it. I'm going to go ahead and introduce Paul. Paul Merriman, as many of you know, is a nationally recognized expert and author on mutual funds, index investing, and asset allocation. Most of you know him through his regular column in Market Watch, as well as his podcasts and website and social media posts and all sorts of things. So Paul is retired in 2012 after a long career in the industry, and immediately took to figuring out how he can use all of the skills that he's gathered to teach people who don't typically have access to that education about financial investments. And so it's within all of our benefit to learn from Paul. I mentioned that he was on our board. He also has his own foundation called the Merriman Financial Education Foundation, where he has sponsored a number of programs like this one to help get financial education in the hands of everybody. And one of his passions, and I encourage you to feel free to ask him about it, is his alma mater, Western Washington University, where Paul just recently created the Merriman Financial Literacy Program, which will ensure that every single student has about 40 hours of financial education before they leave the college. So it's truly the gift that keeps on giving. So with that, Paul, thank you so much for being here. And Christine, thank you for being here. And Paul's going to go ahead and introduce Christine.
Jim, thank you very much. We've been out of town, my wife and I have, for some time, and it is great to see your smiling face.
We miss you.
Be back soon.
Very good.
So this is quite exciting to me tonight. I told somebody today that I was going to be speaking tonight with Christine Benz, and the person that he was with then had to hear all about Christine Benz and what an amazing lady she is. This was not coming from me, by the way. This was coming from the person I was speaking with, and it was great to hear the wonderful things that people think about you, Christine. And it doesn't surprise me because not only do you do some important work at Morningstar, I've been there, I think, about 30 years. And you are the director of personal finance and retirement planning. You do it's called The Long View, a great podcast where you have actually, I think those things each last about 45 minutes to an hour. Terrific pieces, educational pieces to help investors. I understand you've got a new book that's about to come out. I want to ask about that in just a second, but I don't want to miss the fact that Barron's has twice put you on the list of the 100 most, I don't know if the word was powerful financial people or influential. I like that. That's good. And of course the list goes on. And by the way, the fact that you are now the president of the John C. Bogle Financial Literacy Foundation, I think is the name. Am I close?
Center for Financial Literacy. Very close.
Center. Oh, that is marvelous because that organization is working hard to spread the word at a very uh, really a low level where everybody can chime in and learn and share what they've learned. If you haven't been to the bogleheads.com site, you ought to go check it out because you can ask a question there and you'll get 50, sometimes 100 people who will help you. And there's a big conference coming up in Minneapolis, September 27th to the 29th. I'm going to speak. I'm going to listen, and I haven't seen the list of other folks who are coming to speak, but I know after having participated last year, what a group of folks you get out to participate. And John Bogle's got to be smiling somewhere. The work that you all are doing. So tonight, here you are. I know last time you were here, you worked off a PowerPoint and you had to work hard. I thought, could we make it a little easier for you and take on some questions that are on the minds of people? In fact, many of those, I'm going to guess, will be answered by your new book. The title is?
The title is How to Retire, 20 Lessons for a Happy and Successful Retirement, I think is the subtitle.
Terrific, terrific. And as I understand, when we spoke, about half of it is about money, and half of it is about life.
Right.
They do go together.
They do. Can't do one without the other.
That's right.
But it's funny, Paul, the more I have focused on this topic of retirement planning, the more I've realized, it's devilishly complicated. The whole business of accumulating assets for retirement is pretty straightforward relative to the process of, spending from our portfolios. So it does delve into the financial aspect of a retirement plan and creating that plan that, makes financial sense and also gives you peace of mind. But then it's also about all of the other things that we need to do to have a happy retirement. So like how to make sure that we're nurturing our relationships once we leave work. And this tends to be a bigger deal for men than women. Women tend to have social networks that extend beyond work. For men, oftentimes it is their workplace that is providing them with a lot of social interaction. So I delve into that. I delve into the importance of having purpose and why, I think, Paul, you're just such an amazing example of that, though you're not working in a paid job anymore, you very much have something that gets you up in the morning, that keeps you energized and gives you that sense of that you're adding value to the world. And so the book delves into a lot of those dimensions as well. It's been a super fun project and a great learning experience because each chapter is essentially a lesson on how to do some aspect of retirement. And each chapter is an interview with a thought leader in that area about how to do that thing well. So it's been a great project.
And I know that if our viewers want to help that book get at the top of the list, it comes out September 17th, correct?
Exactly.
And so if we all buy that book on September 17th, you're going to come right to the top. People are going to notice it, and it's going to be a bigger success if more people notice it. And I might add, the thing that has helped with the books that I've done, and they don't reach nearly the audience that yours do, but boy, if you can read the book and then write a review at Amazon, that's a powerful thing for an author to have folks say nice things, honest things, we hope, about the book. So stay tuned and put down September 17th. And
thanks for that, Paul. I appreciate it. As I read through it, I'm always really critical of things that I work on. As I read through it, there have been a few nights where I've been so excited about the the wisdom that I think is in the book, and this is coming from the people I've interviewed, not for me, but I hope that it's helpful. I hope that it's useful. It's been inspiring to me to work on it, and I hope people find it
It's
useful.
great. Well, good luck. But tonight I want to talk about the 3 Ds. I didn't tell you that I wanted to talk about the 3 Ds, but here they go: diversification, distributions, defense. And I think those 3 things, if we understand them and we know how to work with them, are huge life changers in terms of potential return. So, with your permission, could we start with diversification? When I came into the industry in mid-60s, diversification was 10 to 20 stocks in a portfolio. That was considered to be enough diversification. Things have changed. What is today the idea of a good diversification, that you've managed risk and you've exposed yourself to something for return? What is diversification?
Yeah, well, it's a good question. I think you get the biggest bang for your buck from a diversification standpoint by diversifying across asset classes. And then maybe even backing up, before we get to the portfolio, if you're thinking about retirement, you're thinking about all of your cash flow streams. So not just your portfolio cash flow, but also other sources of cash flow that you might be able to turn on. So for most of us, Social Security will be a source of cash flow in retirement. For some of us, a dwindling share of us, but some people will have pensions that they'll be bringing into retirement. People might have idiosyncratic sources of income like rental properties that they own that provide them, with a stream of income on an ongoing basis. So the idea, I think, is to try to diversify there. The more of those cash flow streams that you can bring into retirement, that will tend to be beneficial. It will buffer you against relying exclusively on your investment portfolio. So, I'd start there, thinking about diversifying those cash flow streams and maximizing them. Maximizing Social Security is, I would say, one of the first jobs of retirement planning, where you're coming up with a plan for when you will begin taking benefits. If you're part of a married couple, it's helpful to add a little bit of strategy there. And here I would reference Mike Piper's great tool called Open Social Security, which is a free tool that you can use, where you plug in a little bit of detail about your earnings history, your spouse's earnings history, and it will provide you with an estimate of sort of the optimal claiming strategy based on what you've told it. So you can add details about your health history if you think you're in better than average health, for example. If you're worried about, if say you're a younger person, you're worried about potential changes to the Social Security program, before you begin receiving benefits, you can reduce your benefits, give them, say, like a 20% haircut to account for potential changes in the program, and on down the line. So start there. And then, as you're thinking about your portfolio, thinking about the asset class exposures of those portfolios, of that portfolio. That's the best way to diversify the portfolio itself. Just make sure that you have a sensible mix of assets ranging from very safe cash type assets to more aggressive assets with more growth potential, but also more volatility potential attached to them. So that's your globally diversified equity portfolio. And then in between, you'd probably want some high quality fixed income assets. But those would be the big 3 that I'd be thinking about with respect to my investment portfolio. And then within each of those 3 sleeves, but especially the fixed income sleeve and the equity sleeve, I would really go to town in terms of diversifying those exposures. And the nice thing is that, I'm a boglehead. I'm someone who's a believer in the virtue of low cost indexing. You can buy a very well diversified basket of stock investments, bond investments with a very low price tag today. Just buy a total market index fund, a total total bond market index fund. You might add, say, a short-term bond fund and maybe a little bit of treasury inflation protected security exposure, but you don't need to get too complicated in terms of diversifying the portfolio. So I'll just stop right there. I'm sure you have good follow-up questions, Paul.
I want to respond to some things you said. You mentioned cash in the investment portfolio. Now, do you really think that cash should be something in a long-term portfolio? I understand the need, short-term needs, but would you have some cash? And if so, why?
Yeah, so it does depend on the investor's life stage. For a younger investor, a person who's still accumulating assets for retirement, I would, just keep that emergency fund on the side, and I would elevate the size of that emergency fund as I age, because people who are older tend to have more specialized jobs. They tend to have higher salaries. Those jobs can be a little bit harder to replace if you lose them for whatever reason. So I would start building a cash buffer that's more like a year's worth of living expenses as I move into my 50s and beyond. Then in retirement, I do think it makes sense to hold a larger cash cushion as an ongoing part of the portfolio. And there I would think of maybe 1 to 2 years worth of portfolio cash flows that you would hold aside. And the reason that I would do so is to protect you in a year like 2022, where we had both stocks and bonds falling at the same time. Granted, that doesn't happen much, but it has happened. And so the idea is that you do not want to be withdrawing from your assets when they're depressed. You want to have something that you can rely on to supply your cash flows in a year like that. So that is why I would hold some cash reserves on an ongoing basis, just to protect you in that worst case scenario, to give you something to spend from in that bad market scenario.
You know, the first thing that came out of your mouth when you were talking about diversification, you said that the most bang for your buck was to spread your money across a number of different asset classes. Now, I've got to tell you, I started interviewing John Bogle, Tom Cock and I did on our radio show decades ago. And his answer was basically, put your money in the S&P 500. Then a little later, he said it was okay to add a little bit of small, and it was okay to add a little bit of international, but you felt like he was going there kicking and screaming. But it is interesting how the industry has changed. There are still a lot of people who really believe all you need for equities is the total market index, because that gives you exposure to a whole bunch of different, based on cap weighting exposure. Now, I think it would be worth a second if you could address the implications of a cap weighted fund in terms of what an individual actually ends up owning in a total market index or an S&P 500.
Yeah, so the total market index is just how it sounds. It aims to hold a representative basket of all of the companies available in the US. If you hold a total global market, it'll attempt to do that globally. S&P 500 is a narrower basket of companies. It excludes the smaller companies. I think, most investors should probably think about kind of a total market portfolio. I really love the idea of a total global market portfolio where you're holding some of the smaller companies as well as the larger ones. You do see a little bit more volatility in a total market index versus, say, an S&P 500 index. There might be small discrepancies in terms of long-term returns over time. And Paul, you would probably know with more precision than I do, but they tend to be pretty close over time. Maybe S&P 500 has recently looked a little better because small caps haven't been performing especially well, but they tend to be pretty close. You get a little bit more volatility with the total market index, but you also get some more diversification, and you'll have periods when those smaller stocks will really shine. So I like the idea of taking a broader brush to these market exposures.
Well, and of course, these cap weighted portfolios mean that most of the money you make is going to be driven by the top 50 to 100 companies. And in the total market index, there's 3,700 companies, which means that basically the big 100 are still carrying most of the load for that return. So it is fairly it's fairly focused in terms of what it does. And what you're talking about is diversifying beyond that. And by the way, I noted in on your site, there's a great, in fact, we'll have a link to a couple of your reports, one on diversification, one on distributions. They are terrific pieces. I think you come out with them annually, if I'm not
Right.
mistaken. And there's one on target date funds. Again, terrific stuff. But here's what I really thought was cool. Your folks have predicted that for the next 30 years, and obviously they don't know, they're not pretending they know, but they have their ways of predicting anyway, that the large growth asset class, and that's not the S&P 500, that's kind of half of the S&P 500, is going to grow at 8.6, large value 8.8, small growth 10.3, small value 12.9. Now, of course, I'm a fan of small cap value, but it does find it's interesting to me that when I looked then at Morningstar's recommended portfolio, they have 10% in small cap value and 30% in large cap growth and 30% in large cap value. What do you think the thinking is in building a portfolio that, for what they think is going to be the best performing asset class, that they put the least in it?
Well, so I should say, Paul, that those specific return assumptions that you just cited are mainly that we create the portfolio to be kind of a base case in some simulations that we do about safe spending rates for retirement. So it's not necessarily that we think that that is the best structure for a portfolio. It's just the one that we use as the baseline for our modeling of sort of safe withdrawal rates.
Mm-hmm.
So it's not necessarily that we have a lot of conviction in that specific asset allocation, if that makes sense.
So these would be different asset allocations than your portfolios, because you do publish how you think people should build a portfolio, and a lot of people follow that. And what is the theory or your thinking behind your own portfolios?
Sure. So I have a series of model portfolios on the website, and they're there really just for educational purposes. We're not selling anything related to them, but they're meant to illustrate sound investment concepts, sound asset allocation principles. So the accumulator portfolios or the saver portfolios are geared toward people who are saving for retirement, and they are majority equity for people who are younger investors, people who are in their 20s and 30s. And then the fixed income allocation scales up very gradually as people get into their 40s and 50s, similar to a target date glide path. There is a slight emphasis on small cap value in the portfolios for younger investors. Also a pretty fully globalized portfolio, so kind of in line with the US, non-US market cap division for younger investors. And then the non-US piece scales down a little bit as people get closer to retirement, with the idea there is just sort of with a non-US stock portfolio, you're getting some foreign currency risk. And our thinking is that as people get close to retirement, as they get close to actually spending from that portfolio, that you'd want to try to reduce risk exposures like that a little bit. So you should have some foreign stocks as a component of your portfolio as you embark on retirement, but probably not as much as you should have when you're a younger investor. So when people are in the accumulation phase, it's a fairly standard glide glide path, we call it, that gets more conservative and bond heavy as retirement approaches. When retirement approaches, I think people should take a step back. And I think I've talked about this at this event in the past. I like the idea of using this bucket type strategy where you're thinking about, okay, what kind of demands am I placing on this portfolio each year? And I would use that as kind of the measuring stick to determine how much to drop into each of the asset classes. So say I'm using the 4% guideline in terms of my retirement spending. Well, I'd want to think about having, I mentioned earlier, maybe 1 to 2 years worth of cash in the liquid reserve. So I would have, say, 8% of my portfolio. If I'm using a 4% spending rate, I'm thinking about having 2 times that. So that would be 8% in cash, and then maybe another 5 to 8 years worth of portfolio withdrawals in a high quality fixed income portfolio that's diversified across short and intermediate term bonds, maybe hold some inflation protected bond exposure. So again, if I'm using that 4% spending rate and I'm thinking about 8 years worth of cash flows in fixed income, that's another 32% of my portfolio if people are following. So I've got my 4% withdrawal times 8 years, that's 32%. With those two buckets that I've just talked about, I've got effectively 10 years worth of portfolio withdrawals. So Armageddon could happen to the stock market. The stock market could go down and stay down for a good long time, and I'd still be okay. I'd not have to touch any of that stuff when it's down in the dumps. That's the basic thinking here. And to inform how much to drop into those first two buckets, well, we use the probability of having a positive return over that specific spending horizon. So for my very short-term spending horizon, well, yes, bonds are safe, but they're not guaranteed safe. So I'd want to hold cash. If I have a slightly longer time horizon, when we look at the probability of having a positive return over, say, that 3 to 5 year horizon, well, bonds have historically been a pretty good bet if that's your rough time horizon. So that's kind of the thinking in that, how you would structure your bucket type portfolio. And I just think it's an intuitive way to think about asset allocation for drawdown mode, especially for people who are getting close to or in retirement. And the nice thing is that it's really customizable. So for the person who is, say, the pensioner, the college professor, for example, who's lucky enough to have that full pension that's coming online in retirement. Well, the nice thing is, you're kind of building that portfolio for your heirs, for your charities, whatever the case might be. You'd probably want a more aggressively positioned portfolio. But if you're, using a more traditional spend down from the portfolio, you'd want to have more cash and bonds set aside. So I like that you can really structure the portfolio based on whatever cash flow demands that you expect to place on that portfolio.
That's terrific. That's terrific. And along with that, you've recently come out with some new ideas or new numbers for the safe withdrawal rate. And before you talk about those new numbers, I'm not sure that everybody understands what a safe withdrawal rate is. Would you give us a 101 on safe withdrawal rates and then bring us up to date on your thinking about how much we can take out?
Yeah, thanks, Paul, for that question. There's so much confusion about this. And I would argue that this is the hardest problem in all of financial planning, helping people figure out how much they can safely withdraw in retirement. And the reason it's so hard is because you're planning around all these unknowables. So we don't know how the markets will behave, stocks or bonds or interest rates or anything like that. We don't know how long we'll live. And we don't even know, like, when we'll retire necessarily. I've seen data that point to the fact that people are really poor at actually predicting when they'll retire, that there tends to be a mismatch where people tend to think they'll be able to work longer than they will, or than they actually do. And there are a lot of reasons that people do hang it up earlier than they expected. Some, good, maybe their portfolios performed better than they expected, but we know ageism is a thing in our culture. We know that some people have jobs that are physically demanding that they just can't do. People might have health issues or their spouse has health issues. Lots of reasons that people need to retire earlier than they expected. So you're planning around all these difficult variables, but the basic idea is if you're retiring with this portfolio, it seems like a lot of money, but how much can you reasonably withdraw from it on a year-to-year basis? And people tend to be pretty poor judges of this unless they're really steeped in this, in which case they've probably been following the research. But Fidelity did some research on this 5 or so years ago, where they asked people to just sort of guesstimate how much they could reasonably take out. And some of the estimates, frankly, were a little bit worrisome. So I think you had a lot of people saying that they thought they could take 10%
Yeah.
out of their portfolio. Well, if you're planning for like a 30-year horizon, 10% is probably, maybe if you hit it exactly right and your investments perform exactly right, you'll be fine. But for most people, 10% is a risky amount to take out. So people need help with this. But the basic idea is trying to help people figure out, well, how much can you safely take from that portfolio, adding to your Social Security and other income? What's a reasonable amount to take out given how we think that the market might behave? So that's the basic question that we're trying to answer with this research. It's something, Paul, as you mentioned, that we've been working on since 2021, I think was when we initially did the research. And we're attempting to be forward looking. People may have heard about the 4% guideline for retirement spending. This was a guideline developed by William Bengen. Bengen is still conducting research on this topic. I think he's been a really thoughtful voice in this area. But in his research, he used backward looking returns. So looked back over market history with an eye towards saying, okay, if you happen to retire in the worst case scenario, in the worst possible market environment, what was the most that you could have taken over that subsequent 30-year horizon? So Bengen hit on this 4% guideline. Our research is a little different in that we do plug in a forward-looking forecast of 30-year market returns over the next 30 years. So that's a little bit of a variation in our research versus Bengen's research. The idea with our research is that starting conditions matter quite a lot, like what the state of yields are. Today, thankfully, they're a little bit better. We're making some assumptions about what we think inflation will do over the next 30 years. And we're also looking at where the equity markets are. US equities are a little bit expensive to our team. And so we think that investors who are embarking on retirement today should be a little bit conservative in terms of what they expect from stock returns.
So let me make sure I understand this safe withdrawal rate. The 4% suggests that, and that also is going to accommodate inflation as over time, that the money will last for 30 years, right?
Yes, exactly.
Doesn't mean you'll have anything left over. I mean, it's a different plan if you're trying to leave money to people, your kids and charities and whatnot.
Right.
And so that complicates things a little bit because most of us don't like to think about running out of, even coming close to running out of money.
Right. And the good news is that in most market environments, if you use, say, a 4% spending rate as your starting spending rate, and I should say, here we're not suggesting if we say 4%, and that was the conclusion from our 2023 research, we're not saying that you are spending 4% of that portfolio in perpetuity throughout your retirement. What we're saying is that you take 4% of that balance at the beginning of your retirement. So just to make it simple, $40,000 of $1 million portfolio would be your 4% withdrawal in year one. And then you're giving yourself a raise of that dollar amount each year thereafter in retirement. So in year two, it's like, say it's 3% inflation, we're at $41,200 in year two and on down the line, because people do need inflation adjustments, but that's sort of the base case that we use in our research. In reality, people don't actually spend that way. They tend to spend a little bit less throughout retirement because you just sort of lifestyle choices that people tend to not fully take a full inflation increase as the years go by. But that's the base case, kind of straw man case that we use in our research. And the point I wanted to make about that is that in the vast majority of market environments, that'll be too conservative, that people will end up with leftovers at the end of their lives that they in turn can pass to their heirs or charity or whatever their choices might be. So the idea is that most people would rather not run out, not come close to running out. So we would tend to skew a little bit more conservative with this spending rate guidance.
So talk a little bit about, along with this revamping the 4% to 4.5 or whatever, the amount of equity you have in the portfolio. I was fascinated by your study on the difference between 20%, 40%, 60%. It's a big deal. And share that information generally, if you would.
Sure. So it's a little bit counterintuitive, but each year as we approach this research, we do look at how different asset allocations would behave. And you might think, well, automatically, if I hold more equity, I should be able to take more from my portfolio, right? If I'm taking more risk, I should be able to assume a higher return. And the answer is yes, sort of, but you're also adding volatility to that portfolio, and you're also subjecting your plan to what retirement researchers call sequence of return risk. And that basically means if you have big losses early on in retirement, which is something that you run the risk of having if you have a too aggressively positioned portfolio, that can deal your portfolio a blow from which it can never recover, because you're spending from a dwindling portfolio that leaves less of the portfolio in place to rebound and recover when the markets eventually do. So that's the reason why you don't necessarily want to dial your asset allocation up to 100 when you embark on retirement. You want to have that safer stuff to draw upon. In our 2023 research, we came out with, I think, sort of a perplexing conclusion, which is that more conservative asset allocations actually delivered a higher starting safe withdrawal percentage. So that 4% that I talked about, that actually corresponded with quite a light equity weighting. So just a 20 to 40% allocation to stocks, the rest in fixed income assets actually gave you that higher withdrawal rate over a 30-year time horizon. If you dialed the equity allocation up somewhat counterintuitively, your safe withdrawal rate went down a little bit. And that's largely a function of the very conservative spending system that we're asking our Monte Carlo simulations to use. So I mentioned that we're basically asking for kind of a paycheck equivalent throughout retirement. So my 40,000 with my annual inflation adjustment, I'm basically saying I'm going to put blinders on about what's happening with the portfolio. Just give me that paycheck and I keep taking it out. I don't care what's going on. Most people are willing to kind of plug into what's going on with their portfolio value, with their portfolio balance from year to year. If you're willing to be a little bit flexible in those withdrawals, you can hold more equities. You can probably take more over, as a starting withdrawal and over your life cycle, if you're okay with that possibility of having to change up your withdrawals based on what's happened with your portfolio. So if after a bad year like 2022 when almost nothing but cash did well in your portfolio, well, you have to take a little less after that portfolio loss, which can be tough medicine, especially given what we saw go on with inflation recently. Saying someone, not only do you not get your inflation increase, but maybe ideally you would take a little less. Not everyone's good with that. especially with for people with tighter plans where more of their spending is going toward sort of basic living expenses. They may be a little less okay with those sorts of trade-offs. On the other hand, people with plans with a little more wiggle room, where if I'm saying, well, yeah, maybe don't take that vacation or don't take 2 vacations this year, just take one. But next year, maybe you'll be able to take 2 or even 3. People with more wiggle room in their plans are probably okay with that flexibility in their spending. In the paper, we do model out a lot of different spending strategies, a lot of these variable spending strategies. That's really where the action is in terms of retirement spending research. Many people have had a go at this topic, including us. And the conclusion is if you can be flexible with your spending, try to do it, because that redounds to the benefit of your lifetime spending from that portfolio. And by the way, I should also say this ties in with some of the non-portfolio income sources that we were talking about earlier. If you can maximize the non-portfolio income, then I think you can be more comfortable with these variable strategies. If you can kind of match the non-portfolio income sources with your fixed spending, with your, your housing and your food costs and your insurance costs, your healthcare costs, if you can try to line those things up, then essentially your portfolio is kind of providing you your discretionary spending, and you should be able to be more flexible there. So I think those things go hand in hand.
And when I said that the 3 topics I wanted to talk about were defense, diversification, and distributions, I think one of the biggest defensive steps that you can take is to oversave. I mean, who wants to oversave? I want to oversave, because if I oversave, there's room for mistakes in terms of what the market does to me or for me. And if you look at the studies of even an extra 25%, certainly if you're 50% oversaved from what you absolutely need, that is a big, big decision to make. And I want you to help some folks that we have a lot of questions tonight. I've gotten them already, many of them, but a lot of them had to do with looking into a plan like you're talking about, Christine, that going to retire, but they have got all this money that now has got to be in a certain amount of equity and a certain amount of fixed income. And the thing that so many people are afraid of from the first day they invest, they're afraid of, they're going to put the money in the market and it's going to go down. Some people live with that fear their whole life as an investor. So what would you tell people who have ended up, for one reason or another, with mostly cash that they're going to have now they've got to put to work for retirement, to deal with the fact that right now, if I look at the PE ratio of the large growth index, it's 31 times earnings. That's historically a high number. By the way, for people who don't know it, the large cap value index is 16 times earnings. I mean, these are 2 very different markets, and a lot of people don't realize how different they are. But I think what we're concerned about is this 31 times earnings. So you've already given us a hint, I think, that you don't have to be 60 or 70 or 80% in equities in order to be able to underwrite your retirement. But what are the steps that people should take to protect them? What's the defense that we could apply here that would let people do it and sleep well?
Yeah, a really good question, Paul. And I think the key is to have some sort of asset allocation target that you're working towards. So use that as the starting point, like what's reasonable based on my proximity to spending. So I shared a couple of, sort of quick and dirty ways to think about setting an asset allocation target. One, if you're an accumulator, look to a target date fund or look to maybe 2 or 3 target date funds and see, well, what are they recommending for
Mm.
people who are approximately in my age band, at my expected retirement date. I think you'll find kind of a comforting convergence there.
Mhm.
And if you are someone who is closer to retirement, you could use something like that bucket strategy that I talked about. But just make sure that you have some sort of asset allocation target that you're working toward. And then if your portfolio is too conservative relative to that target, I would say, you want to think about using whatever chicken avenues you can take to get you to that target. So I'd think about dollar cost averaging in, so like spacing out my purchases, maybe putting my purchases on a sort of monthly program where I'm just doing that buy of equities regardless of what's going on in the market, and you won't catch it perfectly. You won't absolutely time the bottom, but nor will you, hit the absolute top. So I would take advantage of dollar cost averaging to get the money in line with the target. And I'd also diversify the asset class exposure. So I think one of the best things that US investors can think about with respect to their portfolios today is to just make sure they have that non-US exposure. We've had this period where non-US has really underperformed US stocks, in part because of those magnificent seven companies, some of which I know are based in the Pacific Northwest. It's just the companies that have performed. Some people have done really well with them, but I would make sure that I had non-US exposure in the portfolio. I see that as kind of a backdoor way to diversify some of the risk factors that I think are looming large for the US market. You'd want to think about having small caps and value because, as you said, Paul, the US market is very dominated by a pretty narrow group of companies today. So you just want to make sure that you have other market exposures in the portfolio. So I would just take risk off the table every step of the way in terms of my timing, in terms of the complexion of the investment portfolio. And then, just try to tune out the day-to-day market gyrations. Turn off CNBC, turn off the alerts on your phone that are talking about what's going on with the market, and just stick with your plan. Also, I should say I'm a big believer in people having what's called an investment policy statement where they have documented, okay, here's my target asset class exposure. Here's how often I plan to check up on this portfolio. And I happen to think a good once annual checkup is plenty for most investors, but you're just kind of committing yourself to, here's what I'm doing. And that has, I think, a side benefit that your loved ones could, if something happens to you, they could pick it up and see, okay, here's the sort of rough plan that we are adhering to here in case they need to manage this for you for whatever reason.
So let me see if I could put some numbers into what you just suggested. Are you saying that somebody has an amount of money that 2 years from now, they would like to be 50-50 stocks and bonds? And that during that 2 year period, they are going to need something to live on. And so they would then put that money aside to live on in cash, money market funds, paying 4 or 5%. And then would they dollar cost average in over 2 years, maybe? I mean, we need a period of time that would be reasonable. So by the time that they've done this for 2 years, they've got their cash to live on. They should probably take the rest that you're going to have in bonds, go ahead and put that to work. You wouldn't have to dollar cost that, but you could dollar cost average the other part to where you end up being 40, 50, 60% in equities. Is that a reasonable process?
It is. I think that's a sensible way to approach it. And the value is that you're minimizing regret. As I said, you're minimizing the chance that you'll have put the money to work at exactly the wrong time. On the other hand, I do think time horizon is in the mix too. So I don't imagine that we have many younger investors listening into this retirement conversation, but in case we do, if it's a younger investor, we know that over very long periods of time, the market generally goes up. I would say just get that money in as soon as as is practical.
Yes.
Just get it working for you. But on the other hand, as if you're someone who's in retirement or close to retirement, you do need to protect yourself. And so I think I would be a little bit more deliberate. I think a 2-year time horizon sounds perfectly reasonable.
Yeah. In the past, when I was an advisor, from time to time I'd run into a 40-year-old, 45-year-old kind of an investor that was really worried about taking the risk in the market, and they'd done well. They had accumulated a lot of money. And I would often recommend that if they feel that way, they could be 60-40.
Mhm.
If they would get where they were trying to go. But I encouraged them with the money they were putting in, new money they were putting in, pretend that you were a first-time investor and be dollar cost averaging into the market with the new money while you've got that big base going forward more slowly, more than likely, but at least take the pressure off people worry, because we all know the ad that the quotes from John Bogle: emotions and expenses, those are our two biggest enemies. And can we talk about expenses for a minute? You've already brought up the idea that we should be investing in low cost index funds. Do you think it's an advantage? Index funds are an advantage in every way over actively managed? I know I went back and saw some of your work in 2019. I just wanted to kind of see what the evolution of your work has been. And there was a time when you wrote about actively managed funds a lot.
Still do.
And yes, that's true. But it does beg the question: do we or do we not believe that active management can outperform passive?
Yeah, so we have so much research on what tends to predict good or bad performance among mutual funds. And our passives research team, the team that covers index funds and ETFs, puts out this passive, I think active passive barometer is what they call it. And the basic idea is that it's a temperature check on how have active managers done relative to passively managed funds. And the scorecard is not great for active management when we look at this. It does depend a little bit by category, and it does change a little bit based on time period. So you have categories where the data about being passive are pretty clear. So large cap US stocks, for example, the active managers have not distinguished themselves especially well. Fixed income, it depends on the time period, but that's been a little bit of a fairer fight where bond managers have been able to do a little better than the index over some periods of time. But the big differentiator is fees. So if it's an active fund that has average or above average fees, well, that's a poor bet. If you're looking at the subset of active funds, say Vanguard's actively managed funds, which I hold in my own portfolio, well, there you're starting to look at a fairer fight, that cheap active fund versus the index fund. I happen to believe that it's not that active managers are stupid. It's just that many of them are hobbled by very high costs that make it difficult for them to outperform. So I'm not completely averse to people considering active funds, but do yourself a favor and focus on that. If you like some active funds, focus on that subset of inexpensive active funds. And then I would also say, there are some categories where our team just doesn't think it's a great bet to be passive. So these tend to be kind of niche categories like high yield bonds, for example, or junk bonds. To the extent that you want that exposure in your portfolio, our team thinks that a fund like Vanguard High Yield, I think it's called Vanguard High Yield Corporate, an active fund, is actually better than buying a basket of, sort of low quality, highly indebted borrowers. So we would think that in a few categories you're better off using some sort of an active product, but just keep it cheap, whatever you do.
I don't know if you have a secret thing that Morningstar has on their website and where they analyze mutual funds. The thing that I find that most people don't know about is that price link where you can go into a mutual fund and see the tax efficiency of a fund. And one of the things that oftentimes those actively managed funds, they may have a 1% a year or 1.5% a year loss in taxes because of their turnover, versus the index fund is a third of 1%. That's a huge difference. Now, that's my favorite hidden place on more. Do you have a hidden place that people don't know about that they should go and look and they would understand investing any better? I'm just curious whether you
Well,
have.
that's a good one. And I would say, Paul, that is such an important point for people who have taxable holdings. So that tax cost ratio on the site does essentially show you, like an expense ratio, how much you're giving up to tax costs if you invest with that fund. And as you mentioned, sometimes they can run really quite high. So you're effectively, so say the fund has a 1% expense ratio, you've got this tax cost ratio that's 1%, and your return is 10%. Well, you just gave up 20% of your return with those two line items.
Yep.
So take a look at that. If you're investing in the confines of a tax sheltered account, that tax cost ratio won't matter to you. You're not paying it as long as you're inside of an IRA or a 401k or something like that. But it's a really nice data point. In terms of parts of the site that I like, one piece that I often refer to is we have this markets fair value graph that looks at the price to fair values for all of the companies that our equity analysts cover. So we have a fairly sizable team of, I think, 100 plus researchers on individual companies. And we task them with coming up with a fair value for the companies that they cover. So, if they think that a company should be worth $100 and its current price is $80, the price to fair value is 0.8 for that company. Or if it's worth 100, or if it's currently selling for $120, but again, the analyst thinks it's worth $100, the price to fair value would be 1.2. The fair value graph takes all of those companies together, all of those price to fair values, and bundles them. And I think it's a good way to get a sense of, like, well, is the overall market expensive or cheap right now? So I just, I'm not suggesting anyone do market timing, but I just like to take a look at it just to get a temperature check. Like, okay, it feels like things have gone up and up and up. Should I be worried? Well, right now, for example, I think we're trading right in line with fair value, maybe slightly overvalued, because earnings growth has been pretty good. So companies' actual fundamentals have come up, even though prices have escalated, fundamentals have come up. So that's one sort of, I think, cool part of the site. And I think I'm pretty sure that it's a free part of the website. So it's not like you need to be a subscriber.
That's great. I'm also curious, do you go to individual funds and use the chart function and then compare mutual funds from when they started? I mean, I can go back and look at Dimensional Funds small cap value that started in 1993, put its chart up, and it'll allow me to go in there and put in the S&P 500 from Vanguard, and bingo, we can see how those two funds have done since 1993. And the fascinating part for us I think in learning from that is it's amazing how often you'll have this advantage for one, and all of a sudden it comes down, and then you'll see that they go back and forth. Now, at the end of the day, the small cap value did better, but it went through a lot of periods when you would have been, I mean, you can see that what you're going to possibly have to live through as an investor.
Yeah, I love that. And I love that you can plug in like different time periods to take a closer look at how performance would have shaken out during specific market environments.
So your own personal asset allocation, do you eat your own cooking? Do you yourself invest the way that or have you found more comfort in a strategy that is very different than what others might find comfortable?
Yeah, no, I would say very much I invest in the way that I would tell others to invest. So my personal portfolio, I will say in Morningstar's 401k, we have access to some funds that I like that I will also say I headed up our Morningstar fund research group for a while. So I'm kind of I feel like I'm a better than average fund owner in that actually know some of these managers. So I have Oakmark Select in my Morningstar 401k plan, um, a few Vanguard funds, Vanguard International Growth is in the 401k, and I've owned it, I think, since I joined the company. So there are some active funds in my portfolio. Oakmark would be toward the more expensive side of things, certainly more than I would wish to pay, but that's what it charges, and it's been a good performer. But I think of myself as a pretty good fund owner, and I do own some active funds there, some passives as well. In our personal, and I would say my husband is majority passive in his 401k. And then in our personal portfolio, we've made an effort to be super minimalist there. So we hold a couple of Vanguard funds, Vanguard International Growth, Vanguard Prime Cap Core, for our equity exposure, Vanguard Developed Markets Index, which is an index fund, and some municipal bond funds run by Vanguard, and then Vanguard's municipal money market. So that's in our taxable account. In our Roth IRAs, we own Vanguard International Value. But we have really tried to reduce the number of moving parts in our portfolio. And I just saw the value as I was working on getting our tax stuff ready for our accountant to just really reduce the number of things that we had to send his way, because we try to have just, our 401k providers, our taxable account provider. We've tried to reduce the number of providers, and then within them, the number of holdings within those accounts.
Well, you're such a nice person. You're so good to help so many people that I just can't help but say that I hope you have invested in Morningstar stock.
Well, that's the thing that I've done badly. I mean, I've done well, but I have had a hard time. We actually work with a financial planner, and that's her main comment to us is just like, we got to get rid of this stock because, and we've been trying, and we've been trying to do it tax efficiently, but it's been a phenomenal performer. And yeah, it's been a really high class problem to have that we have more Morningstar stock than would be ideal. Certainly more than I would tell anyone else to have of their employer stock. It's not a great idea to, be simultaneously getting your paycheck from the company where you have a lot of your portfolio staked.
Well, I'm happy for your success. And I think, Jim, it's about time that we take some questions. I don't know if Jim is with us right now, so
Yes, I am.
And can you go ahead and shoot a couple to Christine, since you're on the mark there?
Yeah, that's great. So just to start with, Christine, is pre-ordering your book a possibility?
I think it is, Jim. Thank you for that question, and thanks for the nice soft pitch there, Paul, earlier. I do believe people can pre-order the book. It's called How to Retire. The publisher is Harriman House.
That's great. That's great. Let me look.
Go
ahead, Paul.
Isn't Morningside, it said, this Morningstar, projections over long term equal to average projected return? It wouldn't include risk in short term, so having a 10 in value might be appropriate. Those returns that I noted were not on a scale, and they were not, by the way, average long-term returns, because the average long-term return for the large cap growth and the large cap value would have been higher. Do you want to add anything to that, Christine?
Sure. So in this research paper, which people can actually access if they're interested, it's called State of Retirement. I think you would type in Google something like State of Retirement Income 2023, and you should be able to bring up a PDF of the white paper. I don't think it's behind any sort of like gate where you would need to even enter your email address or anything like that. So you can see the whole research paper, but we do cite the return forecasts that we get from our colleagues in Morningstar Investment Management, and they come up with a 30-year forecast for us. And it's mainly a combination of a 10-year forecast as well as a 20-year forecast bolted on, which is more or less the 20-year piece is more or less historical market returns from these asset classes. For the 10 years, that's a little bit more finely tuned because it takes into account where we are today with starting dividend yields, starting valuations, and so on. And so the expectation is that US market returns, especially in the large cap growth space, will be a little lower than historic norms, simply because valuations there today are much higher than they have been. So that's the reason that that is lower than market history, that 10-year piece of the forecast. For other asset classes, it's just as high over the next 10 years. So their return expectation for non-US equities, for Paul's favorite small cap value, is just as high as I think the long-term norm, but they're haircutting that large cap growth space in particular.
Christine, we had a question around guardrail strategies. And can you talk a little bit about how that differs from the bucket strategy?
Yeah, so Guardrails was a retirement spending strategy developed by Jonathan Guyton, who's a financial planner in Minneapolis. Incidentally, he's going to be coming to our Bogleheads conference in September for people who are interested in hearing from John. But he developed the strategy along with William Klinger, and it's a dynamic spending strategy. So it aims to help kind of reduce spending in bad market periods when the portfolio hasn't performed well, and also increase spending or give retirees permission to spend more when their portfolios have performed well. But the basic idea of the guardrails is that it's putting a limit on how much you can spend in a really good market environment and how little you can spend in a really bad market environment. So it doesn't want to throttle you down so much that your spending really reduces your quality of life. So that's the basic thesis behind guardrails. It gets a little bit complicated. John Guyton pushes back a little bit when I say that, but it's not necessarily a layperson strategy. You really need to read the fine print about it. But in terms of the strategy that delivers the highest starting safe withdrawal percentage, Guardrails is the one of the ones that we tested that does that. And it also kind of maximizes lifetime spending by giving retirees permission to spend more in those good years. The downside, if there's a negative associated with Guardrails, it's that because it does encourage consumption, it leaves you with fewer leftovers at the end of your life over many different market environments. It's encouraging you to spend during your lifetime. And I just want to make a quick point on spending, because I think sometimes people have this negative association with spending that, if we're saying maximize consumption, spend more, we're saying buy a new car every year, go out to dinner every night, or something, frivolous like that. It's really, I think people need to think about spending more expansively to encompass lifetime giving, to see the fruits of your labors, to make a difference for your loved ones during your lifetime. And that's one reason why, and Mike Piper wrote a whole book about this idea of, if you're someone who's in the position of having maybe more than you expect to need for your own lifetime, try to think about ways that you can see that money work for you during your lifetime versus passing it at the end of your life. And Mike evangelizes about this. He's brought me on board with this. And I often cite this gift that my parents gave my husband and me when we were just starting out our lives together. They gave us a nice chunk of money, not a huge sum, but a nice chunk of money to buy a better house than we were able to afford as our entry level house. And they got to see us, live nearby them in their community where we wanted to live anyway. And, just see us not struggle quite as much as we would have with the fixer upper that we were able to afford with our own down payment. So it doesn't have to be big sums of money. This was a small sum relative to what we eventually inherited from my mom and dad, but it was something that I think gave them joy, gave us joy, and it's just stuff to ponder. Helping kids pay down student loans or whatever you can do to try to lighten the load of the next generation.
Jim, are you going to start that? I have watched my parents oversave. Are you going to read that one?
That was one of the ones I flagged. So go ahead if you'd like to.
I just think forget the fact that it's about some big numbers, but this person says, I've watched my parents oversave, now sitting on millions and can't spend anything in retirement. How do I find a balance of saving the right amount and not be shortchanging my todays? Any books, resources to recommend? We have saved millions, have zero debt, fully paid for a house. How do I relax and not stress so much about the long term? I guess we need Doc G here, but what would you say, Christine, to that individual?
Well, for one thing, I would say the struggle is real. And I have been spending a lot of time with this particular issue because, it seems like, it seems like such a high class problem that people have more than they need. But we build our identities around this idea of I'm a saver. This is what I do. I'm a frugal person, and it's very hard to flip that switch when you move into decumulation mode where you've got to spend from what you've managed to save. I think people really do struggle with spending an appropriate amount. I can't tell you how many times I've been at a conference and someone, will come up to me, a gentleman apparently in his mid 80s, who's telling me he's spending, well, I just spend 2% of my portfolio a year. And I'm thinking, gosh, why? So a couple of ideas to help get over that hump. One, and I know in some circles, annuities are a dirty word. And I'm not talking about like the terrible variable annuities that are complicated and expensive, but like a very basic income annuity, I think can be kind of an elegant situation where it's kind of a one-time transaction where you're sinking X amount into the annuity and then it just pays you as a stream of income for the rest of your life. I think that's one idea. It's something that I plan to ponder as I move into retirement. And I have an example from someone who's used that successfully. Taylor Larimore, who is, I think, sometimes called the Prince of the Bogleheads. He's been one of the lead Bogleheads. He's written a book called The Three Fund Portfolio, was in the Battle of the Bulge, turned 100 this past February. Just a real prince of a man. Taylor has an annuity that he purchased, I don't know, when he was 70 or something like that. And he gets these payouts and gives them to his kids and grandkids. That's how he uses the annuity. It's his lifetime gifting strategy, which I think is a really cool use of a product like that, a really great way to give yourself permission to spend. And by the way, I will say, the life insurance company that struck that deal with Taylor, they got a bad deal in that one. And Taylor made out really well. But I like that idea. A financial advisor, I think, is another person who can help you spend appropriately. Dana Anspach is a financial advisor who I really love, who talks about, how she works with her clients and she'll be like, you're spending this money. I'm going to send you a check, whether you like it or not, you're getting a check, do something with it. So for people who really need that discipline, I think using an advisor can help as well. But those are a couple of ideas.
Could you expand on that just a little bit? I think there are a couple of questions about, so what's a wealth advisor? What's a tax advisor? What's a wealth manager? What's a financial planner?
Can you just kind of give a sense of what you would expect a wealth manager to do for a client?
Yeah, and I will say the investment industry has not done itself any favors with this, all these terms. I think it's way, way too hard for people to find a financial planner. Um, there are all different variations. My bias is a little bit more toward financial planning, where someone is going to look holistically at your whole situation. They will do investment management, but it might not be the main thing that they do for you. So I think about the hourly financial planner who my husband and I work with. They focus a lot on tax planning. They help us with decisions like, should we buy long-term care insurance? Um, when can we retire? Questions like that. That's what they do. And I would say that my bias is there because I just feel like you get more bang for your buck versus paying that investment advisor. I think a lot of the investment portfolio management is something that people can kind of do with a little bit of know-how. Whereas the other pieces of the puzzle, it seems like having access to that high-powered tax planning software, for example, that you get with the financial planner, that can be money well spent. So my bias is there for people who do want that ongoing investment management. You would probably want to look to a registered investment advisor. I like the idea of looking for someone who is fee only. So obviously they're not charging you commissions, someone who's a fiduciary. Again, my bias is more toward financial planning. So I would like to see those CFP letters after their name, the Certified Financial Planner credential. I went through the program myself. It's not for Sunday drivers. You need to know about a lot of different aspects of financial planning to get the CFP credential. So I would look for those three things, and also understand that there are a lot of different fee models. So this kind of the baseline model is where someone's charging you 1% of your assets year in and year out. I think that maybe money well spent for some people, but for people who are comfy with the investment piece, you may be better off using kind of a different business model, like the hourly model that I use, or kind of a per engagement model where maybe someone would say, well, I'll give you a retirement preparedness review for, X thousand dollars to go top to bottom on your plan. That might be the better sort of business model to explore if you're comfortable managing your portfolio on an ongoing basis. And I should also say there's been this proliferation of very cheap solutions for portfolio management. So Vanguard's portfolio advisory service, for example, has been raking in the clients because it's a very cheap solution for ongoing portfolio management. I think it's 30 or 35 basis points. So like I think it's either 0.30 or 0.35 per year for that ongoing portfolio management and rebalancing. And I think you also do get some contact with a human advisor. So there are some low cost options that are coming into the space that I think are really good for consumers.
I got really lucky today, Christine. You know that I've struggled to find somebody who's a really great hourly advisor to take the time to understand all the things that we're teaching. And I found a really great advisor who's going to come spend a day with me here and learn what we do and why we do what we do, so that he can be an advisor and help those people on an hourly basis to do what we advise. I mean, if somebody wants to follow our advice, I'm not an advisor.
Right.
But
I love that, Paul. And I will say another misconception that I think is out there a little bit is that somehow the hourly thing is for like people without a lot of assets, or that the hourly advisors aren't especially sophisticated. I will say that the firm that my husband and I use is hyper sophisticated with respect to tax planning. In fact, they work with some CEOs here in Chicago, because the CEOs can do math and say, well, listen, if I have this much in assets, am really averse to paying this ongoing toll in terms of a percentage of my portfolio. I'd rather just pay hourly. So it's not necessarily for less sophisticated investors or advisors, and not necessarily for people without a lot of assets. In fact, if you do the math and have a lot of assets, you might prefer to go hourly and not have that ongoing expense.
Now, is it inappropriate for you to name the name of that firm?
Probably.
Okay.
I think it probably is. I don't probably want to do that in a public setting.
I will probably second guess. I will guess what that firm is, and then those people who are read my newsletter will probably get the name of that firm in my newsletter. Thank you. Thank you very much. We need that.
I will say they have a wait list. That's one
but see,
downside.
that's the problem. That is
They've been
exactly
growing like a weed. Yeah.
It's like John Luskin down in California, in San Diego, I think. I think he's like 8 months or 10 months to be able to have a meeting with him as a new client.
Mike Piper
And
as
then-
well.
Yes. I mean,
So-
these are
That leads me to at least my final question of the night, which is so, and Paul, you talked a little bit about this when you said you were talking about the tax cost ratio and looking at that. So, putting myself in the shoes of a novice advisor, which is generous, frankly, for what I am, but what are the resources? And you mentioned some of these today, but if we could kind of recap on some of the websites that people could go to get some really helpful information, where would you recommend somebody get, a primer on why tax cost ratio matters? And some of these resources would be great to share with folks.
Yeah, thanks for that question, Jim. So I have to say Morningstar.com is a great resource. Lots of free educational materials. All my articles and videos are there, all free, not behind a paywall. The line in the sand with Morningstar stuff is if you want any of the analyst reports on funds or individual stocks or exchange traded funds, that is behind the premium wall. One potential workaround there, as much as I think premium is worthwhile and worth spending money on, is public libraries are sometimes subscribers to a library service that we have. So if you want to just do kind of quickie due diligence on like holdings in a 401k plan, or my advisor is recommending this, I want to do my homework on them, your public library may be a subscriber to that service, and they'd probably be very glad that you take advantage of it. So check that out. Paul mentioned bogleheads.org as a phenomenal resource for all kinds of questions. I mean, you can see people noodling about like the best coffee beans or the best luxury SUV, as well as all kinds of portfolio questions. So bogleheads.org is a wonderful resource. But the boglecenter.net is another website where we monitor our bogleheads comings and goings. So that's where you get alerts about our upcoming conference. You get information about bogleheads chapters. So there are bogleheads chapters throughout the country, people who meet in certain geographies. I believe there's one in Seattle. And there are also Bogleheads chapters organized by life stage. So there's a group of Bogleheads who are talking about all things retirement planning, for example. So that's another great resource. So that's kind of a short list. Paul, am I missing anything?
Well, AAII
Yeah.
has American Association of Individual Investors, AAII.com. You can subscribe for a month for a buck or two. A lot of information. Also at paulmerriman.com, there's a list of truth tellers. And these are the people. It just so happens that Christine Benz is on our list. And somebody she's worked with for probably 30 years, John Reckenthaler, somebody else. I mean, there are lots of people at Morningstar that I respect, but these two are I just think are fantastic. And so we're trying our best to introduce people on our website to folks that we trust are giving the best information. In my case, it's mostly for do-it-yourself investors. And basically, I think that's true with you too. Is that not true, Christine? That that's the base of your business, or are advisors an important part of your
They
business?
are. So Morningstar.com is mainly for individual investors, but we have a lot of software products that are geared toward advisors as well as financial institutions. So we are serving a variety of different audiences, but Morningstar.com is our main portal for individual investors.
And before I forget, next week, Stan, the annuity man. Now, I know that a lot of people say, no annuities in my life. I don't want any insurance person calling on me. I will tell you, this is the most knowledgeable person I have ever met on annuities, and willing to educate people endlessly, and a lot of fun, by the way. He's kind of he'll be in our face. He's not a gentle soul. He's a wonderful, active guy who wants to help folks. I've never met anybody like him. I hope you'll come back next week. And Christine, thank you so much. I really just appreciate what you do. Folks don't realize how many organizations you talk to over the years, and you don't have to. It's not something that Morningstar makes you do. I know that, and so we appreciate it. And I appreciate the fact that you are the president of the Vogelheads organization, or the foundation, and that is such important work. And Jim, thank you for all that you do to help us get this information into the hands of people. I'm sorry we didn't answer all the questions. I will look them over, and I will try to answer some on my site if people are interested. And I'll share some with you, Christine, if you have a way that you respond to folks, although they are not leaving their email addresses, so we can't get back to them that way. Thank you. Thank you.
Thank you. Thanks, Paul. And thanks, Jim, as well. I appreciate you all being here. Paul, I just have to say, you are such a role model to me in terms of just, modeling out what I want to evolve into. I mean, you just continue to live with such purpose, and really are a role model of what we can do with our human capital.
Thank you very much. You're very nice. All right. Thank you all, by the way. Thank you for joining us, and we'll see you next week. And this will be up on the website at BCF, Bainbridge Community Foundation, within a week, probably, Jim.
Yep, that's right.
We'll have it up on our site, and we want to get this into the hands of as many people as we can. So please help us. Thank you. See you next week.
Thank you all.
Night, Christine.
Good night.
Thanks, Jim.
Welcome. My name is John Bajkowski. I'm the president of the American Association of Individual Investors, and I'll be acting as the moderator tonight. And I'm really excited about tonight's presentation. We're joined here by Paul Merriman, and he's a nationally recognized authority on a range of topics: mutual funds, index investing, asset allocation, buy and hold strategies, active management strategies. And of course, as members of the association, you know him as a contributing editor to the AAI Journal. Now, he's a retired founder of Merriman Wealth Management, and he's now president of the Merriman Financial Educational Foundation. He has really dedicated his efforts to educating investors, both young and old. And in fact, I did a Google search on Paul, and the word that popped up was educator. That was right away the first word that popped up. And so beyond working and doing articles for the association, he writes a regular column on marketwatch.com on the retirement page, and he produces a weekly podcast called Sound Investing. So if you do a search in your favorite podcast aggregator, you'll find it quite easily. I think the podcasts only come out every Wednesday, and there was an interesting interview actually of Paul that came out today, and it talked about the impact of community. And I learned now where Paul lives, and I vacationed in Bainbridge, or actually I vacationed in Seattle a couple years ago, and we did visit Bainbridge Island and enjoyed our day there very much. He's author of several books, and soon to be released, We're Taking Millions, 12 Simple Ways to Supercharge Your Retirement Investments. And if you visit his website, paulmerriman.com, you'll find a rich collection of resources. I noticed you can even download a number of books written by Paul at no cost. And one title that caught my eye was Get Smart or Get Screwed. Right. With that, Paul, I'd like to welcome you tonight.
Thank you, John. It is great to be here. I am a huge fan of AAII. I've been doing this for about 35 plus years, and so AAII has truly been an important part of my life. And I like the fact that folks are looking for good information, and they don't let you off easy. You have to answer a lot of questions. So I hope tonight to change some lives. I understand we've got a good turnout, and if I can actually make an impact on 5% of the folks that are here, maybe a tweak here or there in your portfolio, I'm gonna be happy. And then maybe for a few, it'll be more than a little tweak. But we are dedicated at the foundation, and Chris and Daryl are both involved in our foundation as well, and you'll have a chance to meet them. But we are about information and tools. It's information and tools in your best interest, absolutely serving no one but you. So I hope it helps. Now, there are 6 main areas that we focus our work. Tonight, I'm going to be talking about 2 of them. And the first 2 are the choice of equity asset classes that we put in our portfolio. We all know that the gas is going to come, the energy, the growth is going to come out of the equity, and we got the bonds there for the brakes. And so the question becomes tonight, what equity asset classes do we need in our portfolio? And of course, that leads to the question as to how much of each of those equity asset classes should we invest in. Now, the other 4 areas that we do a lot of work with, and I've even added in the PDF some samples of studies that we've done having to do with things like distributions in retirement or accumulating money towards retirement. But we really are focused both for the first-time investor on equities, but when it comes to the near retiree or retiree, we're working about equities and fixed income. And at the end of the day, I think what does differentiate our work from a lot of other people is that we're willing to name names. We are not willing to tell you how much you should have in equities and how much you should have in fixed income, but we are willing to tell you at Vanguard, at T. Rowe Price, at Schwab, at Fidelity, what mutual funds or ETFs you could have in your portfolio. And of course, you all know that this is only for educational purposes. The recommendations are not specific to any individual. If you're a do-it-yourselfer and been with AAII for a long time, you probably don't need to talk to a financial advisor. But if you haven't, I strongly suggest that you do check with your financial advisor. And these are the 3 free books. The first thing we did right out of the gate when I retired, I sold my firm back in 2012, took part of the proceeds, started a financial education foundation. And the first project was to create these 3 books, the one for first-time investors, one for, as John noted, the Get Smart or Get Screwed, how to select the best and get the most from your financial advisor. That was for people who were in the process of hiring an advisor. And I'm a believer that this business is all about coming to simple decisions, forks in the road and making the right decision. And so we wrote a very simple 101 investment decisions guaranteed to change your financial future. All of this was good stuff, except for one thing. I didn't get it. I didn't understand how to transition from being purely an investment advisor to being an educator. Because what I was trying to do, I was trying to show investors, how do you build a portfolio like Paul Merriman has, or like Paul Merriman manages for others, or the folks that work and still work at my old firm. And so what I did was, the portfolio, for example, at Fidelity, suggested this is for a beginner. Put a little bit in an S&P 500, a little bit in a value large and small and REITs and emerging markets and all of these different asset classes. And I went merrily along thinking I was helping people put their life together and making a smart investment, which smart to the extent that that's what I did with my money. Well, finally somebody helped straighten me out. Daryl had been with as a volunteer, and by the way, these guys, hundreds of hours of volunteer hours every year to do what they're doing to help others. I just couldn't be prouder of what these guys have done. But Daryl joined us in 2014, and then in 2016, Chris came aboard. And it wasn't very long before Chris was saying, hey, this is way too complex. You need to simplify. And being a little thick-skinned, I didn't jump immediately, although I thought it sounded like a good idea. But then I visited John Bogle in his office in June of 2017. And he gave me 60 minutes. That 60 minutes turned into 90 minutes. And he did some finger wagging at me. He was a big fan, by the way, of Dr. Fama and Dr. French and all of the work that goes on at the DFA. In fact, he said they were certainly great competitors of Vanguard. But his point was, as good as all that may be, that do-it-yourself investors, and of course that's what Vanguard appeals to, they simply won't do this kind of complex strategy, portfolio building, and stay the course. It doesn't mean that they won't set it up, but then you got to rebalance all these different asset classes and all of the things that investors don't like to deal with. In fact, many of those do-it-yourself investors really should have an advisor. But he was right. I talked to a lot of people after I talked to him, and he was right. They were being kind to me. They were humoring me, but they weren't doing what I was recommending. And so we went back to the drawing board, and with the help of Chris and Daryl, we started to build portfolios of smaller numbers of holdings. But it's not just the confusion of how you build a portfolio or how you manage a portfolio that keeps investors from getting the best return that they should. And that's something we focus a lot on. How do you get the most that you should have coming to you if you position your portfolio in the right way? Now, we never know the right way beforehand, but do we do the best we can? And those things that tend to keep us from getting what we should is, one, not enough time. I'm 77 in a couple of weeks, and I don't know how long I have. And I'm going to be talking about some strategies tonight that look great for the next 40 years. Well, I'm not sure I have enough time to see the big advantage of some of this fine work. And then a lot of people just simply don't have the patience. People, and you had Larry Swedroe on here several weeks ago. He's one of my heroes, and he was talking about how little patience that investors have. That even 3 years is asking way too much of most investors for them to wait for a strategy to do what it's supposed to do. So there's not enough patience, and for many of us, not enough good luck. That's one of the laughs that John Bogle and I had about his good luck and my good luck. His good luck was he started an index fund at the beginning of a period when for 25 years the market compounded at 17+%. I mean, that's luck. On the other hand, had he started that mutual fund in 2000, would he have been the famous man that he ended up being? Because it's compounded at about 6% since then. Well, who knows? But good luck is very important, and not everybody gets it. And also, and this one's a tough one, most people do not have a very good sense of the history of investing. They know how to critique the recent past. We hear a lot about value investing is dead. It hasn't performed well for years. Well, wait until you see how patient you have to be to get the advantage of value investing, at least based on the past. So I think people need a better sense of history, And that's a lot of what our organization is about, because we cannot change people's luck. We are not there to control their level of impatience, but we can help create realistic expectations. I think we can help find the evidence that they can trust. And that's because we're trying to look at evidence over a very long period of time, knowing full well all that evidence doesn't lead to profitability, that the market is going to do what it doggone well pleases, and that's what we have to live with. But we do the best we can with what we have. So our work is about creating realistic expectations, and a lot of that is having to do with the downside. I think what gets in the way of success for a lot of investors, not just this sense of impatience, but they invest with a feeling of optimism. And so that optimism drives them to write some really big checks to get into positions where they think they're going to make a lot of money. And what happens then is they face the normal loss of losing periods that investing gives us. In fact, I used to do 6-hour workshops free to the public, and when I was building my my practice. And one of the points I always made was, if you will follow my advice, I absolutely guarantee you will lose money. And that is something that we need to teach people. It's part of the process. I want to know how much you're willing to lose and how long you're willing to lose it for, in order to look at the past and figure out, okay, with those, whatever your limits are, let's build a portfolio with those limits. So prepare for the worst periods. And then we also have to prepare for this disappointment that we have when we invest in something and at the end of the year, it didn't do what we thought it was going to do. When I was an advisor, I should have kept a diary of the things that made me smile when I had conversations with clients. I would have a client who was 50% in bonds and 50% in stocks. The market would have a good year, and they would call me and they would say, Paul, I'm trying to figure this out. Why aren't we doing as well as the market? Well, it's because you're not the market. You're half in bonds. But people have these intuitive tracking error benchmarks that we have to deal with. And so we need to make sure that investors understand how often and how few times they do in fact track what their benchmark is. And it isn't just about a benchmark for a year. With most real long-term strategies, you need to have a benchmark that is based on decades returns. From time to time, somebody will ask me, how have I done with my own investments? And my answer, and I don't think anybody will ever do it, but what I suggest is, after I die, call my wife and ask how I did. Because the fact is, it doesn't matter how well I've done up to this point. It's how I handle the rest of the way. So we really don't know how good we are for a very long period of time. As you know, the real return we have that means something, that isn't blue sky, is the income we take out of our investments when we're retired. That's real. And then the money that we leave charity and children, that's real. The rest of it is basically blue sky. And so we have to prepare people for the possibility of having things be under their expectation for a very long period of time, which is one of the reasons I think that people are probably more likely to succeed if they are very broadly, massively diversified, so they don't focus in on any one thing too much. Dr. Fama was once supposedly asked, what's wrong with your research? Your research says that small cap is supposed to beat large cap, and for 30 years, large cap has outperformed small cap. How do you defend that? And the response was, you're not very patient, are you? So this is something that we have got to really get through to people, that the expectations that we have nothing to do with what the market cares to do. Now, I love this. Daryl Balls put this together. Many of you, I'm sure, have seen the Callan tables. And the Callan tables will show you yearly results for maybe 20 different asset classes. Wonderful to see the ups and the downs on a yearly basis, but that's noise. And even a decade. And here what we have is we do have 9 decades here of performance with 4 of the biggest, most important U.S. asset classes, equity asset classes: small value, small blend, large value, large blend, the S&P 500, and just so you see how these things look with bonds, long-term government bonds, and a 1-month T-bill. Okay, there's a perfect lesson here. We know exactly what the academics say that should happen if you own these asset classes. Small cap value should outperform small cap blend. It's more risky, and it did, 13.7 versus 12.2. And the small blend should outperform large value. It did, 12.2 to 11.1. And large value should outperform the S&P 500, and it did, 9.8. And stocks outperform bonds. Perfect. Everything worked over 90 years. But when we start looking, and by the way, all that is about taking more risk to get more return. But when we look back and we look at the decades that these asset classes lived through, you can see in the very first one you were tested, because the small cap value is down here at the bottom rather than up here at the top. But that was a very difficult time. The S&P 500 lost during the 30s 0.1%, including the reinvestment of dividends. This does not address inflation. But then for the next 4 decades, things looked fairly good. U.S. small at top, and then the U.S. small blend is sitting down below there, and the S&P down here towards the bottom. And we keep doing that until 2000 through 1990 through 1999, the S&P is number 1. Not by a whole lot, but it's still number 1. And then it collapses the next decade to be the last one on the list. And then it recovers and becomes first again. So what can we learn from all of these gyrations? Well, for one thing, it appears that over a very long period of time, the market comes to its senses. But on the short-term basis, even 10 years being a short-term period, it can get out of whack from expectations. But it also teaches us another lesson that I think is one of the most important on this page. It says, hey, why don't you take a little of the small value and a little of the small cap blend and the large value and the S&P 500, and why don't you create a portfolio that not only diversifies amongst thousands of companies, but also diversifies among different asset classes. Now, there's a debate as to whether small cap value is an asset class, is a sector, what it is. You know something? It doesn't really matter to me so much as it matters that those small, risky companies, sometimes for a very long period, are kind of dormant, and then they explode, and they tend to explode together as a group for whatever reason. You see, if you're a buy and holder, which is what I'm talking about here tonight, then your life as an investor is not about reason. It is not about reason. It is not about trying to figure out, well, who's going to get the presidency, or who's going to get on the Supreme Court, or what are they going to do with interest rates? You know, you're a buy and holder. Buy and holder theoretically isn't supposed to care about that as it applies to the portfolio. So I start then asking questions, not about the intelligence of spreading amongst all of these different asset classes, but what happens if you do put together the more risky with the more conservative, and then let them go for longer periods of time. And as you can see, when you're got a portfolio that's built of 4 different asset classes, you never get to be number 1 ever. So the more diversification that you have in your portfolio, the further away from number 1 you will ever be. A myth. I've got a list of about 200 investment myths. It's going to be part of a book I'm working on, 1,000 things you should know about investing. It's my final work. But here's something I learned. Many of you learned. It's almost impossible to beat the S&P 500. Remember that? Very few people, even the smartest of managers managing billion-dollar portfolios, find it very difficult to beat the S&P 500. Well, it turns out it's really not very difficult at all. It turns out that, in fact, if you look at this particular period, this 90 years, that the 4-fund combo outperformed the S&P 500. Of course, the 4-fund combo includes the S&P 500. And that it looks to me like not only does it not make more money, but I'm looking at all this bad stuff down here at the bottom. Decades when the S&P 500 didn't do very well. Yes, they got to be on top a couple times, but if we go out 20 years, and I know this is not every 20-year period, but when we go out 20 years, 40 to 59, 60 to 79, look at that 4-fund combo sitting right in there. You know, it's not expected to beat small cap value or small cap blend because it's sitting on this large cap value in S&P 500. But I just want you to notice that if we're trying to get young people to invest for the long term, I don't care whether it's the S&P 500 or the total market index, which since 1928 have virtually the very same return, that we may not be giving them the best advice. And a simple 4-fund strategy might be better. The jewel of simplicity. I am not the statistician. I am not the quant in our organization. I am fortunately am stuck being the teacher, but I've got the good fortune of having a couple of really good quants, and I did not know what the telltale chart was, but now I know. And I know that John Bogle, I don't know that he actually developed the telltale chart, but he talks about it in a paper of his, a speech he made, I think back around 2001. And it's a way of showing reversion to the mean and the returns of different asset classes. And what you do is you divide the cumulative returns to date of one series into another. So in this particular case, we're going to look at a telltale chart that the denominator is the S&P 500 and the numerator is the 4-fund combo. And here's the secret that I even understand. When the slope of the returns are going upward, that means that the numerator, or the US 4-fund strategy, is outperforming. And when that slope is downward, it means that the denominator, or the S&P 500, is outperforming. And I will tell you, when I saw that chart, it changed my ability to I think to share the idea of the long term and the commitment to a strategy better than I ever have before. So here is in figure 4, and Daryl put this together. Thank you, Daryl. The telltale chart for 90 years. Starting here, remember when the returns or the direction is here, the idea, the strategy of the four funds is working. It's outperforming the S&P 500. But when it's doing this, it's disappointment because you may have taken more risk in order to get that and you're not getting it. And now we're talking about how much patience you'll have to get it. But you can see, and this is not, by the way, here about the return, but I can tell you here, the whole stretch of this, all the way to the end of the 90 years is about the return, because that is 5.7 times the starting point. So let me tell you what the starting point was with the S&P 500 and the ending point starting with $100, ending here at the end of 2019 with about $450,000. And the four fund strategy, having pushed more upward motion than downward motion, ended up with 5.7 times more, or about $2.5 million. Now, I know that there aren't many people here tonight who are going to live for 90 years, but guess what? Many of you have grandchildren who are going to live for 90 years. And so while this strategy may not be appropriate for you, I'm thinking you might know somebody in your life that could use it. But I wanted to show this particular graph chart because I want to show the period of a decade. And the reason I wanted to focus on the decades, every red ball here point is another decade. I want you to notice that none of those decades look alike. Nothing ever repeats. That it isn't something that a market timer could say, oh, I know what you should do when this does that, and this, and then you get into the US 4 fund and then you get out. No, I don't think there's a pattern here that market timers are going to use. Now, here is what I do know, that this is maybe the most sobering figure of all, because here it shows what would happen to investors who got in at, let's call it the peak. Now, who might get in at the peak? You know anybody who likes to get in at the peak? Well, I know AAII members do not get in at the peak. But let's face it, a lot of investors were very attracted to technology in the late 90s after the big gain had been made. And so they get in, and then all of a sudden, there's more negative stuff going on. The S&P is doing better. It isn't back to even for 20 years. So can you imagine how many articles will be written? The 4 fund strategy is dead. Well, then it came back and it grabbed a little more of the pie. But then it came back down and it was out of favor in essence for 8 years before it broke even again. And then it took a nice run, and then it was flat for 17 years. And right now it's flat for 14 years. Now we could do this same thing with small cap value. And we, by the way, we have. I just only had so much time tonight. But the bottom line lesson here is that when you use strategies that have the potential to add a lot of value, because generally they have more risk, you're going to need to be realistic about the waiting period. So I want my college students to know this. I want them to be committed to hanging up the phone when a stockbroker calls, and I want them to be committed to index funds for the rest of their life. I want them to be committed to indexing for the rest of their life. And I want them to be committed to a series of asset classes that are likely to perform well over the long term. Here's my favorite. This tells it all. It's a little busy, but I want to add one more thing here. Here we have a little green arrow showing from the point that it was back to break even, this run of 5 years, this run of 3 years, this run of 7 years, this run of 5 years. That's what made the difference. Now, yes, so did the recovery. Of course it did, but it was just recovering to make up lost time, to break even again. 70.5 months over that period. I'm sorry, out of the 90 years, 70.5 years, you were underwater. A very small percentage of the time were you doing what you thought you were supposed to be doing in the first place. And that is why I think if we don't encourage and educate and remind young investors or investors who don't understand this process very well, that it's long term. This is a true story. I once had a lady became a client, spent a couple of hours with her explaining the process. She had been to the 6-hour workshop and she committed to having risk tolerance. Yes, she could take it. And she opened the account, and I believe she was willing to lose 20% or some number that was fairly conservative, 40% equity kind of a portfolio. And at the end of the first month, she was down. And she closed her account. And so I called her. We're always worried that we said something that was going to lead to an attorney calling us and saying, "You promised," because this was weird. And I called her and I said, "Do you remember when we talked about the losses that you agreed were reasonable for you?" And she said, "Yes." I said, "Well, what happened?" And she said, "Well, I thought I would go up before I went down." And so she experienced the worst thing that can happen to a lot of investors, not loss in the market, loss of principal. So if we're going to help people be successful investors, we got to be honest with them. And I think this is truth that needs to be known. Chris Pedersen just built this bar graph for us here in the last couple of days. I like it. Part of the reason is because a couple of days ago, I was talking to a fellow who is 68 years old, has enough money from his pension and Social Security, he and his wife, to meet all their cost of living. They've got about $800,000 in an IRA, and he was wanting to know whether using the 4-fund strategy made any sense for him because he's 68 years old. Well, it's the same question I asked myself. Does it make any sense for me to have a portfolio? I have more than 4 funds, but I still have half in stocks, half in big, half in small, half in value, about half in growth, a little less than half in growth, a little more than half in value. But should I be that aggressive? Why would I do that? Well, in his case, look, if you look at all the 5-year periods from 1970 to 2019, and there are starting every month with a new 5-year period, and then when you get to 2019, looping around to 1970 to start over, you create about 600 periods. The average number of periods that beat the S&P 500 over 5 years were 58%. And then when you go to 10 years, it's 61%. And then 15 years, it's 75%. Well, we're talking about more than the rest of my life, more than likely. I have not been kind to my body. I get another 10 here. I mean, this is what I'm probably dealing with. But you go out 20 years, and by the time you go out to 100, and Chris said, You know, I hate to put that number there because people will believe that actually it's guaranteed. No, it's not guaranteed. But I'm willing to take the risk that I will underperform the S&P 500. And I'm taking it myself because my investments are for beyond me. And hopefully my kids will continue to invest money the way I have been. And in fact, we all actually have our money being invested by our old firm. They do what we believe in. But the bottom line is, each one of us needs to ask that question, particularly if we're 80, 85, 90 years old. Is it worth it? Now, by the way, how much more are you likely to get over 5 years? Who knows? Let me give you 5 years you might think about and say, I don't think that's the 5 years that I want. I wrote this down because I knew I wouldn't remember it, but 1995 to 1999, the S&P 500 compounded at 28.5%. The 4-fund strategy at 20.9. You would have underperformed by a lot. By the way, it turns out on average, the difference between the 4-fund strategy and the S&P 500 is about 7% a year. They don't go up and down at the same rate, and sometimes it's fairly radical. But 2002 through 2004, that was my luck. Where John Bogle had his 1976 to 1999 luck, I had the good luck of having my clients broadly diversified, big, small, value growth, U.S. international, all of those things, REITs and emerging markets. But the 2000 through 2004 period, the S&P 500 lost 2.3% a year versus the 4 funds gained 9.4. So I can't tell you what that difference will be. There are too many potential outcomes, but what we know for the long term, it's about a 2% difference in return. So now I'm going to start talking about some portfolios, some simple, easy portfolios. I'm going to compare them. I'm not going to compare very many. I'm only going to compare 11. I hope you like the way I compare them and that you'll do some thinking yourself about how you might compare different portfolios. But I can tell you, if you want to compare more, just go do an internet search for the title, 150 Portfolios Better Than Yours. It was produced by Jim Dahl at the White Coat Investor, or if you want more to choose from, 235 Portfolios Better Than Yours out of Portfolio Einstein. What I'm not going to talk about tonight, I'm not going to talk about 2 funds for life, because that is what I think is one of the best systems in the industry, and that is the work of Chris Pedersen, and Chris is going to be right here AAII on October 21. In fact, they're ready to take reservations right now. The title, Simple and Effective Balanced Portfolios for Lifetime Investing Success. I think it is absolutely wonderful work, and it's something that almost every investor can do. All right, let me dig in. Let me talk about very quickly the 11 portfolios. First one, recommended by Warren Buffett. Put all your money in the S&P 500. The second one, recommended by J.L. Collins. J.L. Collins is one of the heroes of the FIRE movement, the financial independence, retire early. And he has helped young people by recommending that they put the money in the total U.S. market. And then I added one, nobody ever said to buy this one, but I just want you to know it's out there and we'll see how it did. It's a cap-weighted total world market. Total world. So it changes as the world changes. Right now, the internationals are worth less than the US, and sometimes the internationals are worth more than the US. You're going to see how it did over the last 30 years. And what I've done is I've kicked out any fixed income. So when I looked at the Bogleheads 3-fund portfolio, I took out the bonds, because the only way for me to compare all these different portfolios is to get rid of the bonds. Then you can decide how much you should have in bonds. But they are 70% total market US and 30% total market international. And then a little bit of fake news here. I made up as Fama, Dr. Fama and Dr. French, the people who created these two portfolios, 30% in small cap value and the rest in the total US market, 30% in small cap value and the rest in the total world market. And the reason I gave them credit is because they're the ones that did the academic work on factors that alerted people to the small and value premiums. And then we've got one that we've shown for years, all US value. And then one, this is Rick Ferry. Rick Ferry, I think, does some great work. He's got a series of recommendations called the Core 4. And he's got 3 equity funds. So this is a 3-fund strategy as I see it. 60% in the total market index, 10% in REITs, 30% in the international total market. And then the next is the 25% each in the 4 funds US, and then a really clever strategy by called the Trev H, 25% in the same 4 big small value blends, except he does half of it US and half of it international. And then an all value, all world, half in US, half in international. So those are the team, okay? Now we're going to see how the teams did. In each case, we're showing what 10,000 grew to over 30 years. And let me stop right there. 30 years, you would think is a long time and you think it's meaningful. But I want you to know right now, it understates the likelihood of international returns, because the prior 20 years to this 30 years, internationals in some cases doubled the returns of US. In some cases, it was only 50% more than the US. So I want to be careful that I don't misrepresent. These returns are unique to this period. Now, what we know is, and Daryl did all this work. This is great. He shows you how much it made for the whole period, how much it made for each decade, and then what it turned into if you invested $10,000. And by the way, he did include expenses in this, even though they were indexes that we tracked. You would have made more if you were in the total market, because it made 0.2% more. You would have made less if you were in the total world, because internationals were the pits, and instead of making 10%, you would have made about 7%. The 3-fund strategy from Bogleheads, the 2 equity portion grew to be worth 125, 126. The total US with 30% small cap value, 258. The total world with 30% small cap value, 150. The all value US, just the 2 funds, 50% each, 325. Now, before I leave this page, I want you to notice Daryl also gave us information on the good years and the bad. And there's another thing you should know about that is biased about this 30 years. There were only 20%, 6 years, the S&P lost money. That is 20% of the years. That is way lower than we would expect in a 30-year period. We would expect 25 to 30% of the years to be losing years. So you always got to be careful to understand the history behind any performance. And here's the worst year, 2008, a loss of 37. The total market, a loss of 36.6. You'll notice they're all about the same. They're around 38, 39, 40. So it didn't matter in terms of the worst loss that you sustained. Then we have Rick Ferry's, his core, just the three funds, the three equity funds grew to 128. Now Rick's got a portion of that, a sizable portion in international. So it would have done better if you could include the previous 20 years. But you can see it did do better in that period, 2000 through 2009, than the S&P 500. But its loss, its worst loss, and he had 7 of them, its worst loss was around the same as the S&P 500. And then we get to the 4 fund, the one I've been talking about all night here. It grew to 283,000, 11.8% compound rate of return, 6.1% in the 2000 through 2009 compound rate of return. It had 7 losing years. The worst year, 2008, down 38.2, virtually the same as the S&P 500. Now the Trev 4, remember, he's got half of that money in international, but he still did pretty doggone well for having half that money in internationals, 162,000. Shows the help that value gave that portfolio. Small value, large value. And then an all value, half US, half international, 235 with a portfolio that we recommend. So there are a lot of people who will say over a lot of years, all the strategies come out about the same. No, they do not come out about the same. Now, maybe if you went out 50 years, they would come out about the same. And I will tell you, we're working on that too. And we will report that. I hope every one of you becomes subscribers to our newsletter, The Price is Right, or read our articles at AAII, because we'll do our best to help there as well. Numbers, what I love. You know, it's interesting what numbers do to some people. They put them to sleep. I'm not going to spend here very much time because it will put some to sleep, but I know the people who really like numbers will be back, or they'll look at the PDF, because not only do I have numbers here going back 30 years, but you'll see a lot of numbers in that PDF go back 50 years. Now we're going to look what the ride was like year by year for each one of these. I'm not going through every year, but I'm going to point out here that in 1990, the first year of the study, down 3.1, this magic portfolio from Merriman, 4 funds down 15.7. How you feeling so far? And really, you don't see massive advantages until you get up here into the period of 2000 through 2002. Because I already told you we underperformed in that 95 through 99 period. Look at those years the S&P 500 had. 37.6, up 23, up 33, up 28, up 21. Did you know that people at the end of that run, when they were surveyed, predicted that for the next decade, the return for the S&P 500 would be 20 to 30% a year? Is there any recency bias showing itself there? Well, I think there are some of you who really take this stuff to heart and are really thinking about, well, what might you do? By the way, let me just suggest for some of you, you might have an IRA, Roth IRA, you got a regular IRA, you got a 401k, your spouse has some of the same. You could set up one in a 4-fund strategy and another account in a 3-fund strategy. You could diversify. It's not difficult. None of these are hard to rebalance. And thanks again, Daryl. Oh, my God, you make my life easy. Look at this. What a story this tells. What a story this tells about those same returns, but highlighting each year the very best and the very worst. And then you sit back and you kind of look. What are the conclusions intuitively? What do you see here? Well, for one thing, I see the S&P 500 is either a lot of the time at the very top or at the very bottom. That it maybe isn't as kind of dependable as what I always believed that it was. Even down here at the bottom, they have the best decade in 1990 to 98, the best in 1910 to 2019, and then the worst, 2009 through 2000. What do I see? I see some people are not either honored or cussed ever, because they're never the best and they're never the worst. You know, for a lot of people who have found great comfort in balanced funds, they like the bonds and the stocks, makes them feel good. They're never the best, they're never the worst. And yet most of those balanced funds, the equity portion is sitting in something, oftentimes like the S&P 500, or oftentimes something very value oriented, which is not bad. I'm just saying that notice how up and down the value was. Although the value had more green than it did yellow. There's some good lessons here. I do see this. I notice that Fama and French, they may not have recommended these portfolios, but they did just fine, and they didn't make it to the top or the bottom. Well, we are here to help with podcasts. We've got over 500 of them available to you, over 300 articles, mutual fund recommended portfolios, and ETFs. I have to tell you that Chris Pedersen has done all the work on the ETF portfolios. I know he's written, by the way, he's written an article on choosing ETFs at AAII. He has a new article coming out in the first week of October on the two fund strategy, I believe. And lots of other ways to try to help investors. Here's that book that John mentioned. I'd like to say it's worth taking millions, but we're talking millions. And this is 12 simple ways to supercharge your retirement. Now, we don't know if we can get a 20-year-old to even think about retirement, but this book was written for them, or 30-year-olds. And we didn't want to put on the cover what we believe, because we don't think people would have believed it. But each of these very simple 12 decisions, 12 steps, 12 ways can be converted into an extra $1 million plus over their lifetime. And I'm not talking about people who are investing $50,000 a month. I'm talking about families that are investing a total of $5,000 a month. And it's built to be as simple. Rich Buck and Rich has been working with me for over 30 years. He actually is the guy who knows how to write. I'm the guy that knows how to come up with the ideas and to edit. And you wouldn't buy this book if I wrote it, but Rich does know how to write. In a couple of weeks, I'm going to be on an evening conversation with Rick Ferry and Larry Swedroe, sponsored by Choose FI. Choose FI and AAII have so much in common because they really are dedicated to lots of education. Choose FI is trying to help the 20 and 30-year-old retire by the time they're 40 or 50. I'm sure a lot of their parents would prefer they'd never found Choose FI, because one of the things a lot of those kids decided to do was to move home and live with their parents to save money. Interesting outcome of life. Anyhow, I hope that you'll have a chance to come join us. Rick and Larry are two of the brightest people I know in the industry, and I probably won't have a whole lot to say, but I am honored to be amongst their company. And by the way, if you do sign up for our newsletter, you will be contacted for an offer. It won't last forever, but for an offer to get a copy of our new book. It will be a PDF copy. And what I want you to do when you get that is I want you, please, to send it to the young people in your family. And then I'd love for you all to go write a review at Amazon. Well, that is the end of my presentation. And John, I'm up. It's up to you. You're the boss now. I'm ready. And
well, thank you. Do you want to bring up your other panelists, Ryan? Do you want to put them on the camera, please? Why don't you do quick introductions, please, for the audience?
Yes, absolutely. So we have on our panel, as Paul was alluding to, Chris Pedersen, who helped him put together this presentation. I say hi, Chris.
Hi.
And Daryl Balls, who also put together some of the tables and data that you saw in the tables. So welcome to the panel. And I guess this is the time now for the Q&A portion of tonight's program.
Yeah, and Paul and his guests have agreed graciously to stay on for the next half hour. And they're also going to take note of all the questions you've submitted, and they'll answer them afterwards as well if you don't get to them tonight. And so great presentation, Paul. Brought up a lot of great questions from our members. And let's start off here with let's see here. How do I, let's see here. In your book, 2012 book, Financial Fitness Forever, you recommend REITs to be a portion of your portfolio as they rescue risk and increase return. And amongst your allocations there, it was about 12%. You're wondering, this person's wondering how do the REITs play in today's investment environment and the allocation?
Well, John, in that book, there was an assumption that there was a combination of fixed income and equity in those portfolios. But when we look just at equity, it represents 10% of the portfolio. And what we do in that book is we start with the S&P 500 and what was the return, and then we add 10% large cap value. What did that do to the portfolio? What did it do to the risk? What did it do to the return? And we keep adding 10% at a time. And the REITs are number 5. They come in and they add 1/10 of 1% rate of return over the 50-year period, or whatever period that we ran that particular study. The addition of REITs reduces the risk. In fact, it has more impact in essence on the risk than it does on the return. But historically, it has added 1/10 of 1%. So it's not a make or break deal. And of course, REITs are not supposed to be in a taxable account. They're supposed to be in a tax deferred or tax free account. But I have no reason not to have that 10% position. It hasn't been a good year for REITs, but it hasn't been a good year for a lot of things.
That's for sure. When the opportunity comes up, I've got a fan here. A question for Paul. And he's listened to your podcasts. He's been actually doing 2 podcasts a day since last December. And he's been one of those people that's in the past invested with emotion. And he gets it, he understands it, and it was a bad choice on his end. Moving forward, if a person has, let's say, money to invest now and 401k, regardless, and they're in the 40, regardless of what they have invested in the past, the ship has sailed in the past, what's 10 years to retirement? What's the best strategy to go going forward?
Well, the best strategy is going to have a lot to do with his risk tolerance, his need for return, what kind of income he needs to get out of that. You really have to address it as a financial planner first and foremost. Also, what level of complexity, whether he wants to work with one equity fund or a lot of people. In fact, Chris, I mean, I realize when you're 10 years away from retirement, the two funds for life may not be going to make a great difference, but it could be so simple as two funds for life. So what would you say to that?
I think two funds for life might work, but I would also say exactly what you started with, and that's that there's just too many things about his circumstance we don't know. So spending a little time with a planner would probably not be a bad thing. If he was your client, you would have spent a half hour with him, at least maybe an hour or two, right, before you could come up with a plan. And so, yeah, I think it's too many things we don't know to answer the question.
But here's what I could say, though, that might help. In the PDF, we have two examples of a fine-tuning table. That fine-tuning table shows the returns from 1970 through 2019. It shows the S&P 500 as the equity position, and in another table, it shows the four-fund strategy as the equity. And then what it does, it has columns of adding fixed income, 10% fixed income, 20% fixed income, 30, all the way up to 100% fixed income. And what that table shows is the risk of those different combinations of equities and fixed income. Because what he's going to have to deal with, I don't care whether he's on which side of retirement he is. I mean, I'm almost 77 and I'm half in stocks and half in bonds. Well, that's not what Vanguard says to do. I should be 30% in equity and 70% in bonds. But my situation warrants my choice of how much in stocks and bonds. But those tables are to help do-it-yourself investors kind of come to grips with that risk-return relationship they've got to try to create.
Very good. I've got another member here, Greg, and he's wondering, okay, let's say what's the best way to determine what portion, let's say I invest in a four fund portfolio, what portion or which funds would you recommend to be in the taxable side versus the non-taxable? Any thoughts along that way?
I think we actually, and help me on this, whether we actually made a difference on those differentiated between, for example, the Vanguard taxable and the tax deferred. You could see that, in essence, at our website. We have all of these portfolios at Vanguard Fidelity. We have them for taxable and tax deferred at Vanguard. So you could see what we recommended, and then you'd have, for example, you have, Chris, you have ETFs that are both for taxable and tax deferred. So your list would be a possible source of what to do as well.
Yeah, we differentiate the fund recommendations for taxable and tax deferred, but John, was the question how much to have in taxable and how much to have in tax deferred?
Is there any advantage to, say, put large caps in a tax deferred account versus small caps? Is there any thoughts along?
So not portfolio location versus allocation.
I think, yeah.
Okay, all right, yeah. So yeah, then putting REITs, they're income producing, they're going to produce taxable income, putting them in the tax deferred accounts is a good strategy. Fixed income produces, more taxable income that tends to be better placed in the tax deferred accounts. So you can balance that out with shifting some of your equities that are going to be high growth, low dividend into your taxable accounts. because they're not going to generate as much tax liability on an annual basis. They'll let you defer the tax because until you sell it, you don't realize it, right? So yeah.
Just a person here who, thanks Paul, thanks for all you do for young investors. And all three of his children, their ages 15 to 21, and they've started their own IRAs.
Hey,
And,
good.
his two oldest children have taken, the belief and they listened to your podcasts, and he's passing them on. The two oldest ones are happy to go with ETFs, but there's one that's looking at actively traded funds. Any advice you can
I
give
want to
them
talk to that kid.
Very good.
Isn't that interesting, though? Isn't that interesting how you can lay out all the evidence, and the brokerage industry? And I'm not being mean about this. They're good people, but they have to defend their particular business, and they are able to convince people that they can pick the people who are going to outperform the market ahead of time. We all know better, but it sticks in people's minds because it makes sense that smart people should be able to figure this out, even if I can't.
I agree. It's always a challenge, with bond yields being so low and low interest rates. A person here is wondering, Joshua, whether it's better to be in dividend funds, all equity. Any thoughts as far as that element versus doing equity income funds versus bond funds?
I unfortunately did not wear my hearing aid tonight. Would you?
The bond yields being so low
I didn't hear.
And interest rates are low. Any thoughts about using dividend equity funds as opposed to bond funds to get income in your portfolio?
No, I'm not a big fan of that, because those of us who, for example, lived through 73 and 74 and saw dividend-based funds go down 50%, know that those are not the same as bonds. We really do believe, and a lot of folks, Larry Swedrow would agree with this, I'm sure that Rick would agree with this, that your bonds are there as a break, and that the stock is your growth. And so you want to have bonds that really perform well in difficult times, but be more growth oriented. I'm not talking about the NASDAQ or high tech. I'm talking about diversified portfolio. It could be big cap. It could be the S&P 500 is fine, but that you're better off if you look back at 2008 or years like that. What bonds did well? We certainly wasn't the dividend companies that did well. It wasn't the high yield bonds that did well. It wasn't the high grade bonds, corporate bonds that did well. It was the government bonds, the rush to quality. And so that is the approach. And then we use or recommend, or I use personally, a total return as the basis of my income distributions from all of our investments. So some year it could be coming out of fixed income, another year it could be coming out of equities. Depends on what the portfolio has done. And sometimes we do things that aren't very smart, like my wife and I. We take the money out the first week of the year. And the reason we do that is that we don't want to be thinking about the market going up and down when we have to take money out every month. And so that's our low emotion bar there.
Well, sometimes it's best just to have a system and stick with it, right? I mean, it's just take the emotions out of it. Any thoughts about using a equally weighted index versus a market cap weighted in one's portfolio construction?
Either one of you guys want to take it?
I'll take it. Yeah, or go ahead, Daryl. You got it.
I was going to say that the four fund combo that Paul talked about, while it is not an index, it is an equally weighted investment. It's 25% each in those four asset classes. And so you sort of create your own index at that point with rebalancing between the asset classes whatever your rebalancing philosophy is. Go ahead, Chris, what you were going to say.
I was just going to say that an equally weighted fund is going to give you some of the same tilts. It's going to give you a disproportionate amount of small and value compared to what the market cap weighting is going to do, and so it'll help a bit. We don't have as much history that we can model it with, and you will pay a little bit for it too, because there's trading costs to manage that, right? So it's hard to say exactly how it would have compared in the past because there's not as much history for us to leverage. Yeah.
And I think too, just to add a thought on that, there's a debate going on that I'm not sure it's as open and honest as it can be. There's this debate about small cap, about I've got the total market index, and therefore I have as much small cap as I should have. I have 5%, and even that might not be right, because that 5% might be mostly growth oriented, and growth small cap doesn't do as well as value over the long term. So you're not even adding very much, but it's such a speck of impact on that total market index that it's not you're not saying you don't believe in small cap or small cap value. You're saying, yes, I believe in it, but I don't want more than 5%.
Yeah.
And I think it may not be going all the way as my wife and I, half in small cap and half of that small cap value, and half of that is international. It is a question of, well, how about 10%? Would that make a difference? And that's one of the things I know Chris will talk about when he does his piece later in October. 10% can make a difference. It can be what I'll call life-changing, particularly if you can do that with a 21-year-old or a 31-year-old, because even 10% is better than just sitting there counting on the 5% that's even the wrong 5% on top of everything else.
You know, and if someone has a shorter time horizon, let's say someone has a 5-year time horizon, you know, what would your thoughts be? Should they still go with the 4-fund approach, or should they tailor their investments depending upon a shorter time frame?
Personally, I don't. Of course, I want it to be longer term. It would depend on how much they need the money. We do a lot of work on distributions, and we have two kinds of distributions. We have fixed distributions where we up the ante every year by inflation. Then we have variable distribution for people who save more than they need. And so my goal was to save more than I needed. And if you can save twice what you need, if you can do that, and people can, I had to wait and retire later, but I finally got there, then you can afford to take more risk like this. And of course, the older you get, in theory, and you've heard this from a lot of people I know, John, about as you get older, you can actually have more equities in your portfolio because you're not going to live very long. And if you have enough money, I mean, you have to have enough money to do that.
That's the key.
But it's a really personal thing. I think it's important that we have a reason. I have a foundation. I have almost solely funded the foundation. We've had a number of people donate, but mostly it's been my money. And when I die, more money goes into the foundation, because I want to have what we're doing for people to continue after I'm gone. You have a continuity at AAII to do the same thing. And so my money is invested for the next 100, 200 years, I hope. And so I'm not afraid, but I don't blame somebody for, in fact, a lot of people shouldn't even be in equities, particularly the people who are going to bail out when the going gets tough. In fact, it's amazing how many people I talk to that what they should have is a single premium annuity life policy that guarantees them a pension for the rest of their life instead of putting that money in the market and screwing it up and walking away with half of what they need.
It's very true. I mean, discipline is important, and understanding how you're going to react when the market is down is critical, because any good strategy can be destroyed.
Yeah.
And a question here, as far as, you know, obviously the time period 1990 to 2019 didn't really favor internationals. Any thoughts about internationals going forward, or, you know, whether or not they should be in a portfolio?
Are you asking for a prediction?
You know,
I've got them in my portfolio. How stupid am I? I mean, I by the way, don't answer that question. But why would we not invest in internationals? There is always list A, the good news. There is always list B, the bad news. You just need to pick your list, and then you can start figuring out how you should invest. I mean, when somebody tells me, an 80-some-year-old man tells me, when Clinton is elected, sell everything. And I said, John, why? He says, I'm not having a penny in the market with that guy as our president. I spent an hour, 45 minutes or an hour on the phone with him, talking him out of it. And this is the challenge. Why would you not want to have that greater diversification where the expected return is basically the same, except you have currency diversification? Having said that, if you feel happy and secure with home bias, it's like, was it Peter Lynch said, buy companies you know and understand. Well, for me, that would leave every technology company out because I don't understand them. So yes, international should be a part of the portfolio.
Very good. You know, here's a kind of a question that's a little bit more broad-based here. What's the most common mistakes you see young first-time investors make?
Go ahead, Chris. I know you've worked with a lot of young people.
Probably not as many as you, but probably the mistake that comes to mind the most is performance chasing. And the reason is that there's this opportunity to learn the wrong lessons, right? So whenever we make a choice, we can make a smart choice or a bad choice, but the outcome depends, especially over a year, as much on luck as it does the quality of the choice, right? A year in investing just isn't long enough. So a lot of young investors will make a choice, and at the end of the year, look back on it and draw some kind of a conclusion that's just not valid. A good example, I have a nephew who was exposed to Paul's work. He learned a lot about the value of tilting towards small in value. He put all of his money in small value mutual funds, and after a year said, why am I underperforming the S&P 500? And the answer to the question is, if you wanted an S&P 500 return, you should have invested in the S&P 500, but you wanted something different, right? And you know it doesn't all come in a year. Sometimes you have to wait a long time for it. So I think the biggest mistake a young investor makes is drawing the wrong conclusions on too little data that depends on luck, right? He could have invested in the S&P 500 and decided at the end of the year, wow, this is the best thing since sliced bread. I'm going to stick with it forever. And actually, if he sticks with it forever, he'll do just fine, right? You know, the most important thing is probably getting them investing young and having them have the discipline to put it on autopilot and stick with it. But I think just too little data, wrong conclusions. That's probably the biggest mistake a lot of young investors make.
And this question has come up, so just in case people are having some confusion, you know, which 4 funds are you talking about? And I think you also talk about them in a September journal article, if I'm not mistaken. So just to repeat them so everybody could hear them.
Oh, do you remember, guys, what we put in there?
Do you know what you modeled it on, Daryl?
I'm not sure I remember the specific, what was used in the specific article.
It's the same 4 I think you guys talked about tonight.
Well,
no,
well,
they were,
what we used
those
in
were
the
the asset-
analysis.
excuse me, go ahead, Daryl.
No, no, Paul, go ahead, you.
No, those are what we talked about tonight are the asset classes.
Right.
So if you went to Chris's list and you wanted to do this with the ETFs, you could look at the large cap blend, the
I
large
can give
cap
you those.
value,
Yeah.
small
So
cap blend, and the small cap value ETFs.
yeah, so if you went there, you'd get for large cap blend. There's a little bit of an exception, and I'll come back
in
to
the
it.
article you guys used the S&P. I guess we presented the Vanguard version of them and Fidelity as well. So in the article itself, we had the Vanguard 500 fund and then the Fidelity equivalent on the S&P 500 side. On the large value, we had again the Vanguard and Fidelity ones, VVIAX and FLCOX. On the small blend, on the Vanguard side, we had the VSMAX, and the Fidelity side, the FSSNX, and for small value, VSIAX, and for Fidelity, FISVX. And again, members of the association, it's available on our website. You can download that article. And what we'll do tomorrow is anybody who signed up for the webinar, we'll send out a link to this broadcast, a link to the slides, and we'll be sure to put in any kind of notes, including a link to the September article that Paul wrote, and as well as anything that Chris has written in the past as well. So it's we'll get a reference to all the articles and information about the upcoming webinar as well.
Thanks, John.
See here. Any thoughts about value investing versus index ETF investing?
Well, value investing is an asset class, and an ETF is a bucket. You could own that in. You could own it in an ETF. You could own it in a mutual fund.
Or you could do it with a set of stocks, right? There's a lot of different ways to do it.
You could create in one of these platforms your own group of value issues if you wanted to.
So the key is to come up with an asset allocation you want and then find the best instruments basically to build that allocation.
Here's the thing. Chris has taken the time and he updates this. He'll be updating it after the first of the year. He has gone through all the ETFs in each of those asset classes, and he has tested them for all the things that he's looking for to make them the best ETF to actually capture what he wants or what we want out of these asset classes. Now, having said that, that means that we have chosen to select small cap value that is truly small and actually smaller than some so-called small cap value that are almost mid cap value. So what could happen here, and this is this problem with people being impatient, is in a market that large outperforms small, larger small cap value is probably going to make more money than smaller small cap value. And so it's important to understand that Chris's picks are not guessing what kind of small cap value, the larger or the smaller small cap value, or the more deeply discounted, but to find the ones that he thinks are going to work best for the long term. And so we get, in fact, I just had somebody wrote and said, how come you're recommending a small cap value when I would make more money if I had put my money in the small cap blend Vanguard fund? Well, he's asking that because the small cap blend has done better than the small cap value lately. And I said, well, because the small cap blend is not a small cap value fund. And that's confusing to people because there's still, you talk about young people, the focus on getting rewards now is such a big deal. I got a wonderful email somebody thanking me profusely who saw me speak. I have a class up at Western Washington University that our foundation sponsors, and I go up once a quarter and I teach one of the classes. And he remembered me fondly. And I thought, hey, this is great. And then he went on to tell me he had put his only $10,000 he had to invest in a high-tech stock for 85 cents a share. And I didn't know the company, except that this company had been worth over $110 a few years ago, and must have had something very exciting in their life, which is now for some reason proven not to be so exciting. So on top of everything, he was doing everything wrong. He bought a penny stock, put everything in one stock, and I wanted to go shoot myself. Instead, I just smiled inside and thought, this is what evidently some kids have got to go through. We don't want them to do that. We want them to do the smart thing from day one. But Wall Street, and I don't mean all of Wall Street, but the allure of the big hit, the allure of retiring young because you might get in on the ground floor. Well, he was getting in on the ground floor possibly, but the wrong end of the ground floor at the end of its excitement rather than the beginning. And yet he took my class. What is going on there? What did we do wrong?
So we're running a little bit late on time here. So let's, if you could close on one question here. What guidelines do you have for rebalancing as far as frequency?
You want to take it, Daryl?
Well, there are a number of different ways you can rebalance. I know Paul, or I believe Paul, does it strictly on an annual basis. Same day every year, just looks at it, sees what's out of whack, fixes it, and moves on. Myself, my wife, and I, we use 5% bands. We use Larry Swedroe's 525 approach. We check it once a year. So we have sometimes twice a year. We check it, and if it's out of whack, out of those bands, we bring it back to the bands, be within the bands. I know other people do it on a more or less frequent basis. I don't remember what you do, Chris.
We do, I'd just call it patient, like every year or two. And I've done a lot of analysis where I've gone and looked at what happens if you rebalance monthly, what happens if you rebalance yearly, and the changes are pretty subtle. It's not dramatic, and so we're pretty patient about it. Yep. And I do it when I'm calm.
When you're calm, that's good. Just I'd add one thing. It's not good to rebalance too often. What it does, it reduces your risk because you tend to move money from the high-powered stocks into the low-powered holdings, typically, and it will likely reduce return, but you will reduce risk. And I think let those winners go for a while.
Sure.
We've even looked at the possibility of not rebalancing.
So, but having probably a system in place is the most important thing. Determine in advance what's going to be your trigger, and don't let your emotions determine the balancing part, but really let your model determine that. Well, gentlemen, thank you so much. It was a wonderful presentation. A lot of great questions, and we'll do our best to answer those via email. I think you guys are going to handle that. And we'll get those to you. We'll get those to the gentleman here tomorrow. And Ryan, please take it away.
Sure, absolutely. I want to thank the panelists tonight for a great presentation. Probably, I would say, our most well-attended presentation so far. We do have a number of other great upcoming webinars. If you're interested, the website is www.aaii.com/webinars to register for any of these fine webinar Wednesdays that we do. Next week, we are featuring AAII Journal editor Charles Ropeblut, who will give us an update on the AAII Way project, which is a plan he's developing along with the community here to develop your own personal investing plan. Check that out next week at 7:30 p.m. The following week, we will be rebroadcasting a webinar we did with Craig Israelson on retirement portfolio analysis, a multi-decade review. Check that out on October 7th at 7:30. The week after, we will be hosting Mabane Faber, whose webinar is called The Tale of Two Tails, Strategies for Up and Down Markets. You won't want to miss that. That is October 14th, again at 7:30 Central. And Chris Pedersen, who was on our panel tonight, will be hosting a follow-up webinar to this one called Simple and Effective Balanced Portfolios for Lifetime Investing Success. I believe he will be detailing the two-fund stuff that they were talking about this evening. That will be at the end of October, October 21st, 7:30 Central. Again, please register at www.aaii.com/webinars. These are free, and we invite you to participate. We did record this webinar, and that link will be posted on this website as well and sent to your email address when it becomes available. With that, thanks so much for everybody for joining us tonight.
Thank you, Ryan.
Thank you. And
Thanks.
we wish you all good health and good wealth. Good night.
Good
Good night.
Well, I will tell you that it is rare. When I get up in the morning, the day that we're going to record a podcast where the three of us get together, I am relaxed, I'm excited, and I'm ready. But I will tell you, today's podcast and video, it has created an actual sense of anxiety. And the reason I feel anxious is because this, in some ways, is where the rubber does really meet the road in terms of the work that we're doing, helping you very specifically, because to the extent that people rely on the information that we are sharing, that you are making decisions about what to do with your investments, that's a really big deal, because we can talk generically about things forever. But when we put 6, 7, 8 different portfolios on the table for you to consider, and then you have to pick one, the question is, what do we need to tell you about those portfolios that help you make that best decision? And of course, we never know best until after we're laid to rest, right? I mean, the bottom line is we don't know the future. But today, the three of us are going to do our very best to walk you through the portfolios that have been created. A few of them, some of them, were created decades ago. And the ones that I think people have the most interest in are those that were created in the last few years. And so we're going to go through these. We know we're going to get a lot of questions, and we'll do our best to answer those in a way that they help you make a decision, because remember, we are not investment advisors. We are not here to talk with you one by one and take into consideration all those important things we need to know about you. This is to give you choices as a do-it-yourself investor to find what is the right thing for you and your spouse to do and your children to do. So let me give you a very brief, if I do anything briefly, I'll try to do this briefly, background on these portfolios. We built a company, the Merriman Investment Management Company, or the Wealth Management Company. And it was built on giving people a free education, 3 to 6 hours of a lecture. And some people came out of there, I know, scratching their head, not knowing what to do. But I offered everybody a free consultation. Come sit down with me. Let me see, should you be a buy and holder? Let me see, should you be a market timer? Let me help you figure that out. And so we had these portfolios for do-it-yourselfers, happy to help them. And one of the sneaky reasons we did that is because we believe that if we helped you take care of your do-it-yourself problems, you're going to tell somebody, you know, if you want somebody to do it for you, go see Merriman. And it worked, because People trusted us because we gave them the tools to do it on their own. And those tools were the Vanguard portfolio, recommended portfolio, Fidelity portfolio, a T. Rowe Price portfolio. Now, the reason for T. Rowe Price, because it is not an index family, is because so many people we spoke with had T. Rowe Price in their 401k. So we were trying to be accommodating so they would know what to do with their 401k. And over the years, we added Schwab. And we even, in the beginning, we didn't have REITs. And then after, I don't know how many years, 5 years or so, because we started in the mid 90s, we added REITs to the portfolio. And then, and by the way, a lot of people were using these. We call this the ultimate buy and hold strategy. We still have it. We still make recommendations at Vanguard. In fact, Chris, you might even be able to pull up the Vanguard page on the buy and hold portfolio, and you'll notice that the portfolio recommends not just the 10 equity funds. Well, if the fund family has all 10, I have to note, because if they don't, we have to make some changes in the portfolio that will allow us to balance the portfolio between US and international, and maybe we have to overweight something in order to be able to fill out the 100% portfolio, but it would be close to what we wanted people to do. And we did a Vanguard portfolio for tax deferred folks, IRAs, 401ks, Roths, tax free. And we showed an aggressive strategy, a moderate strategy, and a conservative strategy. Aggressive was all equities, moderate was 60% in equities, and conservative was 40%. And then we referred you to the fine-tuning table to determine what the risk was with each one of these portfolios. So we have a fine-tuning table for the worldwide ultimate buy and hold strategy so that you could look to see what kind of risk would I be taking if I took a worldwide strategy like that and I put a certain amount of fixed income in with that portfolio. And I see Chris is right on top of it here. Now, these numbers are small, but I can tell you that from the left to the right, we go from all fixed income to all equity in 10% increments. So you, as a do-it-yourself investor, could figure out, okay, what are the implications of having half my money in stocks and half my money in bonds? Or as a younger person, maybe I was comfortable with 80% in equities. And then at the bottom of the page, we hit you right between the eyes with the tough times. The thing that I fear that will cause people to change their long-term commitment are those terrible losing periods that are simply part of the process. So at the bottom of the page, people could see, okay, do I have the risk tolerance to stay and accept the loss? For example, with a 50-50 strategy, you have a period that you're down, I think, if I understand here, about 27% for the worst 12 months. Maybe that's too much. Maybe you have to be 40% equities. So you see what we were doing. We were trying our best to give you the tools way back in the mid 90s. We just didn't have all these additional years to put in the table. We're getting crunched right now. We've come to a point where we almost have decided to go strictly for 50 years. In fact, Daryl, are we going now for 50 years or 51?
The update I just completed on the fine tuning tables has all 51 on it, but you can decide how many lines you want on the table.
Okay. Okay. We may have to make it a 2-page table, right?
You can do that.
But the bottom line was we were trying to give you the ammunition to make a decision. And we did the same thing with Fidelity. Now, as we've updated the Vanguard portfolio, we have used Vanguard funds. In the case of Fidelity now, let's just take a look here for a second. Well, we've done basically the same thing. We have, except in a couple cases, we don't have an asset class, so we filled it in with an ETF. So we did something a little different with Fidelity than with Vanguard. And one of the reasons we did that is because it seems like, Vanguard people really want to hang on to be strictly Vanguard investors. We understand that. You think low expenses and broad diversification. And maybe one of these days we'll start filling in an empty spot with an ETF at Vanguard as well. But right now, all equity funds and bond funds at Vanguard, some ETFs at Fidelity. And then we have T. Rowe Price did the same thing, aggressive, conservative, moderate, did the same thing with the T. Rowe Price. There it is. And by the way, those funds have been almost the same for since we started doing this in the mid-90s. And it's still a fine fund family. It's just actively managed and expensive compared to Vanguard or going the low risk, low cost way at Fidelity. And then we have Schwab. Now, in the case of Schwab, what we have are people who are sitting on Schwab 401k plans, and they have access to these funds. And so we've tried to accommodate them. And we've continued to do so. Now, there's another group we're not going to show you, and that's going to be all of the 401k plans that we analyze, because we tried to do the same for 401k plans. It became a nightmare. It took a lot more time, and then we had the resources to keep up. And so we have put that on the back burner. But I just want to give you hope, because I have seen the work that Chris has created in helping people think through their 401k plan with the things that we believe are the right steps to take. And he's got a great way of helping you, very simple, I think, help you sort through your 401k and put together the best ultimate buy and hold that we would be able to do if we were there to do that analysis one by one. So this is the background that for literally decades I was working with, and Rich Buck was working all those years with me. Rich is the one who still is working with me and with the firm to the foundation to educate folks in the written with the written word. I think he's done a marvelous job. He makes me look way smarter than I am. Well, if not smarter, more organized. I will, and I think you gentlemen would agree with that. But now we have something more to do to help people. And this whole change started in the 2016-17 time period, when we started figuring out ways with the help of the major part of the work was done by Chris, but Daryl has been an important resource for us, and I've tried to help as I can. But now we have all of these different portfolios that we are holding combinations of value and small and large and US and international, but doing it as a small portfolio, not as a big portfolio, doing it in a way that makes it possible for people to maintain it without all the challenges of rebalancing the portfolio with 13 pieces. And the two funds for life, of course, that Chris has developed, that allows people to work with two funds and to be able to make one simple decision, computation a year in order to manage that portfolio. So those portfolios have been added. And what we'd like to do today, first of all, I would like to ask Chris to take a tour, if you would, Chris, through those portfolios that are the smaller, easier to manage for folks, and to talk a little bit about, from your viewpoint, why these are easier, and I think, to be fair, some of them aren't simple, the ETF portfolios, because what we've done is we've used ETFs to replicate the old ultimate buy and hold. That is not necessarily simple unless we do it at M1. And if we get a chance today, we can talk about that briefly. But walk us through those other portfolios, if you would.
Sure. So since we're already over here on the fund choices, we walked through the mutual fund families. The ETFs are basically, they're very similar. They're just a different mechanism. They're just a different investing vehicle. Mutual funds give people a few benefits that are very valuable. When you buy a mutual fund, you buy at the market value of the underlying assets when the market is closed in the evening. So when you say, I'm going to buy 100 shares in the evening, that price is set, and that's what you get, is 100 shares at the market price of all of the underlying assets. When you buy an ETF, it's kind of the mirror image of that, or the yin yang opposite. You're buying while the market is open, and you bid for it just like you would a stock, or you buy at the market price. And because of that, there can be a little bit of a difference between the price that you pay and the price of the underlying assets, and that's called the spread. There is another benefit to ETFs compared to mutual funds. In mutual funds, you can be exposed to capital gains as a result of other people's trading, not your own. In ETFs, they have a mechanism of trading in kind that effectively lowers the liability that an investor is likely to see of other people's trades driving capital gains. So ETFs tend to be a little bit more tax efficient. Mutual funds tend to be, not have the spread. Those are the two things, I think, financially that you run into. But in terms of ETFs, we added those as much as anything because M1 Finance and Motif Investing, Motif no longer available, but both of them allowed fractional trading of ETFs in these easy to assemble pies. So there we have the Vanguard ETF portfolio, which it looks very much like what we just saw in terms of the mutual fund. And in fact, many of these are underlying, following exactly the same indexes that the mutual funds do. We have, you can continue to go through the recommendations page to get to the other ones. We've got the best in class article, which describes why we choose our best in class ETFs. And you can see those here. And then we have, under ETFs, we also have the best in class portfolios. And these, rather than being of any one family, are all of the different families are considered, and we choose what we feel is the best from all of the funds available for any one of these asset classes. And so these represent the US large cap blend, US large cap value, small cap blend, and so forth on down. And you can see we have the aggressive, moderate, and conservative, just like we had with the family specific portfolios. And I think that covers the ETF section here. We
Can
do
I
have
add a comment here,
yeah,
Chris,
sure.
just a sec. I think it's also important to note, probably most people know this, but these are ETFs that are traded commission free at Vanguard, at Fidelity, at Schwab, and now TD Ameritrade, because it's part of becoming part, or is part of Schwab.
Yep.
And so the only real challenge you have, because regular old mutual funds, yes, you you do trade commission free if you go in and out. But as you noted, with a mutual fund, whether you're a buyer or a seller, at the end of the day, it's the same price. There's no, like you say, no difference whether you're a buyer or a seller. That's magic, really, in a lot of ways in terms of efficiency. But with the ETFs, that is not a one price environment. But these are available, and there may be even more brokerage houses that these are available commission free. We just haven't checked them all out.
Yep. And Paul, what I think you were alluding to next is that if we scroll down on these, beyond the ultimate buy and hold portfolio, we also have the all value portfolio, the all small cap value portfolio. We have taxable versions of these because it impacts the fixed income choices we would recommend. And if you want to see these other portfolios under our best advice, you can come down and you can see we have the ultimate buy and hold strategy and the fine tuning tables, which we already talked about. But then farther down, we have the 4-fund combos, where we have information on how you would build a portfolio using just the 4 funds of U.S. large cap value, U.S. large cap blend, U.S. small cap blend, and U.S. small cap value. So we've got a little more, than just the all value that's down here, all small cap value, all value. We also have the 4-fund combo, and then we have the 2-fund for life options as well. And it takes you in yet a different direction where, we talk about ways you can start with a target date fund and augment it with a second fund that is either fixed or varies with age.
So for just a second, can you go back, Chris, to that all value portfolio that you were there a minute ago? And because it obviously has more than 4 funds in the portfolio, and just talk for a second about what this is. What is this comprised of?
Sure, and we have this for this is the ETF page, the best in class ETF page. But we also have it for Vanguard and for mutual funds and various choices. And what you see in here is you can think of it as starting with the ultimate buy and hold and pulling out the things that don't fit all value. So there's no large cap blend. There's no small cap blend. This is a U.S. large value, a U.S. small value, and then we have international large value, international small value. And we keep emerging markets in there, and we do that both for the all value and the all small cap value as a differentiator. Since you're concentrating into a smaller number of asset classes, and these strategies almost by definition are a little bit higher risk, a little bit higher return, it makes sense to keep emerging markets in there because it's a little bit higher risk and a little bit higher return. But because it goes up and down at different times from the US and international markets, it provides a little bit of or diversification. And then we have down here the fixed income, which is Vanguard short-term government bonds, Bloomberg Barclays intermediate term treasuries, and TIPS, Vanguard short-term inflation protected securities. And so for the moderate and aggressive, we always carry a mix of those 3: short-term bonds, intermediate term bonds, and TIPS. And we preserve the ratio of those. It's mostly intermediate term treasuries. Second highest allocation is to the short-term bonds, and the least is to the TIPS.
And I think it's important for people who don't know our portfolios that these fixed income securities are selected not because they pay a lot in dividends or interest. They don't. They are there for stability. And when you suffer the worst times in the market, in most cases, you're going to find a rush to quality fixed income. And that has historically been US government bonds, which is the reason we do not include international bonds in the portfolio, because when you add international bonds, it is going to, under certain conditions, cause more fluctuations in the portfolio. No, we're looking for less fluctuations because of the bonds. And so we get a lot of questions about that. And I just thought I'd use this as an opportunity to slip that in. Chris, thank you. Go ahead. I'm sorry.
Perfect point. I think that's all I had to say about that. Where did you want to go next, Paul?
Well, it is, how does a person think through this? And what I'd like to do, I'd like to come back to returns in a minute, because returns are obviously what people are really focused on. But Daryl, I wonder if you would step in here and let's be very clear. We are not financial planners. We are people just that had a ton of experience, some professional, some amateur, but solid experience with not just the statistical aspects of investing, but the psychological aspects. And so with all of those different portfolios in front of you, Daryl, how would you counsel our listeners to pin down the one that would be right for them?
Well, I don't remember who said it, but I think the first thing you need to do is to know yourself. Because one of the biggest dangers, if not the biggest danger to your portfolio, is you. So I think there are several considerations that go into selecting a portfolio that's right for you. I think you have to be concerned about your own behavioral aspects. How much effort is it going to take to maintain the portfolio, both for you, if you're the one who's put this together, and your survivor, if they have to assume responsibility for taking over whatever's going on in terms of portfolio management. And then there's performance. Okay. If you mess up these things, these first three things, your performance is going to suffer dramatically. So while performance may be a consideration, probably is a consideration in your portfolio selection, I'm not sure it's the most important consideration. Behavioral aspects kind of relate to things that it's Paul's "I can't stand it anymore" theory of portfolio management. Will you be able to deal with the uncertainty in terms of expected return? Will you be able to deal with the drawdowns when they happen? You can look at it and say, oh, I can deal with a 30% drawdown, but can you really when it happens, This is the thing about it. If you have $1 million portfolio and you think you can deal with a 30% drawdown, you say, oh yeah, I can handle that. Okay, well, how would you feel about losing $300,000? Oh no, I can't handle that. Well, they're the same thing. So you need to think about what the drawdown is. And the volatility. The ride can get pretty rough sometimes. And so how are you going to respond when you do that? Some of these portfolios have many funds in them. Some of them don't. So the amount of effort that you have to put in to maintain the portfolio is different between the ultimate buy and hold worldwide portfolio and the 2 funds for life portfolio. There's the amount of time you have to spend doing that, and maybe the frequency that you have to spend doing that may be different from one portfolio to the other, depending on how you choose to handle things like rebalancing or adding contributions or taking distributions or maintaining a glide path, if you have to do those things. One of the things that I'm sure us older people here have thought about recently is how are our survivors potentially going to do with this portfolio? How can they do they have the interest or the capability to do that? or as you get over even the ability to do it in terms of things like cognitive decline, for example. How will they be able to manage their portfolio? What's the plan for that? Then finally comes performance for the portfolio. These portfolios have different potential expected returns on them. Some are larger than others. Well, what does that mean in terms of meeting your financial goals? Well, it means how much you have to save per year, how long you have to potentially save that in terms of your investing horizon. So your savings rate, those all these things play together. And from a qualitative perspective, I think you need to look at the quantitative data, but think about them in terms of a qualitative assessment of your ability to manage a portfolio. You can use the data that we've provided in terms of the fine-tuning tables and Chris's data that he has on the various two-fund for life approaches. And you can see what the performance is, and you can see how you have to go through and maintain the portfolios. You know yourself, you should know yourself, whether you can handle those aspects of the portfolio, whether your survivor can handle, and then make an assessment on whether the potential future performance of these portfolios, based on what they may have done in the past, would be sufficient for you. That's a long-winded way of saying you need to know a lot more about yourself than you need to know about the portfolios themselves.
Great stuff, Daryl. I really appreciate that. And let me just touch very briefly on what I'll call the traditional way of looking at performance. And then Chris has taken a different approach to looking at that performance. But so I'm going to start, and I'm going to share the old-fashioned way. And here's what we know. When I look at the worldwide ultimate buy and hold strategy, using the 10 different equity asset classes, all equity. In fact, in each case, it's going to be all equity because that's the fair way to compare them. And what I know is that over the 50 years, I've not seen the very latest data. I know that Daryl's working on that right now, but I can tell you that over the last 50 years, if we look at the S&P 500, the compound rate of return was 10.6%. If you look at the ultimate buy and hold strategy, and Daryl applied expenses, by the way, he applied expenses based on today's expenses, not on what they were 50 years ago, because that would be a very different view of these returns. That's a discussion for another day, but it is important. What we know is 12.6 for the ultimate buy and hold. The 4-fund strategy, all US, 12.3. The small cap value only 13.7. The all value that Chris talked about, 12.5. So here's all we know from the past that I think that's important, is that there has been a premium for having built the portfolio on something then the highest quality asset equity class that you could select, which would be the S&P 500. So as Daryl said, returns are important, but there are a whole bunch of other things that are going to likely impact the return that have to do with you. But this is what we know about the past in terms of just the pure return of these asset classes. 50 years, is that enough data? Well, it's interesting to note when we look back even further that these strategies where we have the data hold up in favor of the people who expand the portfolios beyond large cap blend. So that's the traditional way of looking at those numbers. And I'm going to have links in the write-up on this podcast and video that will send you to the fine tuning tables that we did last year on these very same portfolios. And you can see the difference between the risk and the return of the different strategies. Now, that's the traditional. And Chris, I would love for you to put up that table that you showed, not only the adjusted return or asset allocation, but also some of the points about each of these portfolios and what the considerations might be in your particular selection as an investor.
Didn't know we were going to share that, but I'll pull it up. Sure.
Okay, good, good.
It'll take me just a second. One of the tricky things for us, I think, is that we have not on the website come up with a great way yet to do apples to apples comparisons of these various approaches. And the reason for that is that when we do the back tests that Daryl does, he does one path through history. And when you have a changing asset allocation, like you do with two funds for life or a target date fund, that could be a lucky it could be a lucky history. It could be an unlucky history. You don't know.
It exposes you to sequence of returns risk.
Yeah, right. Exactly. So for the two funds for life, I always do a rolling return analysis, and to get enough to test all of the start dates and not overweight any part of the return sequence too much, I loop around. So when I get to 2019 or 2020, I go back to 1970. And so that produces a different set of analyses. And that makes it hard to do an apples to apples comparison. And it means a lot of people looking at our work then are frustrated or have questions. It's like, well, which of these do you recommend? And I really like Daryl's answer. It depends on you, right? That's essentially, I can't tell you which one's right for you. It depends a lot on you. But let me share this. This is my attempt to talk about how I see the differences. And I tried to do pros and cons, and I also tried to come up with some rough equivalent percentages of equity you would hold to get similar total lifetime results over a lifetime of contributing a regular amount for 40 years and then taking out 4% for 30 years. So we'll talk about that in a minute, but there are basically 5 fixed allocations we advocate on the website. There's the worldwide ultimate buy and hold, the US 4-fund combo, a worldwide 4-fund combo, which we've started talking about recently, the worldwide all value, worldwide all small cap value. Those are the 5 fixed allocations that we have described on the website. Then we have various flavors of two funds for life. We've got a 90-10 two funds for life, where 90% is in the target date fund and 10% is in a second booster fund or diversifying fund of something like small cap value. But we also presented that as an 80-20. And then we have the 1.5 times age in target date fund. So you would say you're 30 years old, 1.5 times your age is 45. You would put 45% in the target date fund and the rest in your second booster fund. We've also described this 2.5 times age minus 25, so that when you're 25 years old, you're 100% in your booster fund, and by the time you're 65, you're 100% in your target date fund. More recently, I've started thinking about like putting a floor in there as you go into retirement, holding maybe 10% or 20% in this second fund as you go into retirement. And then we have the Merriman Aggressive target date glide path. So that's 5 different flavors of two funds for life. 1, 2, 3, 4, 5. Yep. And it's 5 different flavors of the fixed allocation. So that I think the headline, the starting point is, do you want to see your risk change over your lifetime, or do you believe it's going to change over your lifetime? Do you want to have less risk in retirement than you have in your accumulating years? If or do you want to have the same risk profile throughout? Do you look, if you look at those fine tuning tables and you say, you know what, I can live with a 30% maximum drawdown. That's all I'm ever going to be able to live with, but I can live with it forever. Then a fixed allocation's a fine plan for you. But if you look at it and you say, I'm young and I'm not really sensitive to the drawdowns, I can live through a period of 55% drawdown when I'm 30 years old. And I'd rather do that so that I accumulate faster in the early years and then see the risk decline as I get closer to retirement and even decline into retirement. Well, then you should be looking at a target date fund at the least and potentially be looking at a 2-fund for life strategy. So I think that's the big fork in the road at the beginning is, do you want to have a time varying amount of risk or not? And if you do want a time varying amount of risk, you at least should consider the 2-funds for life strategies or a target date fund. You could do it on your own though. And Paul points this out all the time. You could look at the fine tuning tables and say, you know what? I really like the 4-fund strategy. And when I'm 25, I'm going to be 100% in equities. When I'm 40, I'm 100% in equities. And when I'm 45, I'm going to go to 20% bonds. And when I'm 60, I'm going to go to 50% bonds. And when I'm 65, I'm going to, you could create your own glide path. You could do that. And there's nothing wrong with it. Perfectly fine. It's just a different way to get there. We will never be able to tell you how that's going to perform because everybody's going to create their own version of the glide path. And it's just too many moving parts and pieces for us to answer every question. It's too variable, right? So I've listed then down here some pros and cons of these different approaches. And under the ultimate buy and hold, I think it's the most diverse in terms of its asset classes. These are the pros. It's got broad geography coverage and it's got regret avoidance. You're going to have your fingers in 10 different pies. So in any given year, if one of those pies does perfectly or if it's the best in that year in terms of performance, you've got some. If you go with the 4-fund strategy, even though it in our back testing performs very similarly, there's a chance that that year emerging markets was the big winner and you're not there. If you're US only, international might have had a great year, you're not there. Worldwide 4-fund combo doesn't have REITs, doesn't have emerging markets. So even though they might have over the long haul a similar kind of performance, you have this chance that you're not in the hot thing in any given year, and it causes you to lose sleep or feel bad. When you go into worldwide all value and worldwide all small cap value, you're effectively taking on a little bit more risk, a little more concentration, a little more chance of regret for hopefully a little bit higher return. So those, they've got these different flavors. And the cons are kind of similar, just the opposite side of the same coin. You've got worldwide ultimate buy and hold it's got the complexity of 13 funds. We've already talked about US, it's US only, you're missing the internationals. So these are largely mirrors of the other things I talked about. The real cons though, with all these fixed ones is that your risk doesn't reduce with age. And if you're contributing monthly during accumulation, then you're going to have a smoother ride in accumulation than you have in retirement. Because in retirement, unless you withdraw monthly, and very few people do that, most people do more like a yearly withdrawal, you're going to see the highest drawdowns in retirement. So it's kind of the opposite of what you might want to have. But you're going to actually see the bumpiest ride in retirement with a fixed allocation because you're doing the drawdowns less regularly than you did the contributions. The other thing that happens compared to the 2-fund for life or a target date fund or those strategies is that if you squeeze the risk into the early years, you have a bigger bundle of money when you get to retirement. And that's when you typically set your withdrawals. So squeezing the risk into those early years means you have to tolerate it. You have to stick with it through bigger drawdowns. But when you get to retirement, you're likely to have more income in retirement. If you stick with a uniform allocation throughout your life, you're likely to have less income in retirement and leave more to heirs. So kind of another pro and con.
So, Chris, can I ask about this top line? Or maybe you're going to get back to this later. I want
Which
to make
one?
sure the line that says 1.5 times the target date fund equity equivalents.
Yep.
49%. What does that 49% represent?
That is where I was going to go next. So perfect
great.
lead. Thank you. Yeah, you're doing a good job keeping me going.
No.
If you look up here where it says 1.5 times age in target date fund to fund for life strategy, that says as is. So what that means is that you're going to get the total return that's represented on this line with a 1.5 times age in target date fund. And then the question is, well, what would I have to have in equities in a worldwide ultimate buy and hold to get the same total return? And that would be the withdrawals as well as what you leave to heirs. And the answer is, if you were 50-50, roughly it's 49% on the chart, but if you were 50-50 for your whole lifetime, you would get about the same total financial benefit that you would if you did the 1.5 times age in the target date fund strategy to funds for life. And if you compare that, the worldwide 4-fund and US 4-fund are both about 50% as well. The worldwide all value would get you that same financial benefit with about 40%, 43% in equities. And the small cap value would get you that same financial benefit with about 36.5% in equities. If you move on over on the chart, what you see is that the 90-10 produces about the same total financial benefit. The 80-20 produces more. And then the more aggressive two fund for life strategies all produce more. They would all generate more. The second line on the chart, well, you'll notice over here on the right, it says Merriman aggressive target date glide path. The second line says as is. So the second line is, well, what would you have to have in equities to get the same total financial benefit across your lifetime that you get in the Merriman aggressive glide path? And the answer there is that the worldwide ultimate buy and hold would be about 72%. The US 4-fund combo is 74. The worldwide 4-fund combo is about 70% in equities. All value, you're close to 62%, and all small cap value worldwide is 51%. And the less aggressive strategies don't produce as much total return in the two fund for life, which is what you would expect. But there's this added one I threw in there, the 2 times age minus 25 in the target date fund ramping to 20% in the second US small cap value, that produces pretty close to the same return as the Merriman aggressive target date glide path. So you can get much of the same benefit you get out of the Merriman aggressive target date glide path with only 2 funds if you do it the right way. Yeah.
So if we go back to the first, the far left-hand side of this table, and that says, actually, this would be true of the 4-fund strategies. If you started an account as a 21-year-old and you put basically half of your money in either the 4-fund or the US or the worldwide, and that's what you did for the rest of your life, that you would walk away with about the same amount of money distributed and left to heirs as if you did a 2 funds for life starting at age 21.
Yep.
And so for the person who does it at age 21, they're going to have, let's call it 20 to make it easy for me. They're going to have 70% in a small cap value and 30% in a target date fund. And 90% of the target date fund is equities. So, I mean, in most cases. So they are almost all in equities. As opposed to this, or compared to the person who puts away half their money in equities and half their money in fixed income. So in theory, what we're saying there is, and it may be hard to find this person, but theoretically, for somebody who's pretty conservative, who's afraid to go in the stock market, they could be convinced to do half of their money in the stock market and the other half in something very low risk, that they would get used to that by the time they're 40 or 50 or 60, and then could continue on with that same portfolio for the rest of their life. Does that include annual rebalancing?
It does. So that is another thing to think about, is just, and Daryl touched on this, the behavioral differences required for these different approaches are substantial. If you're a worldwide ultimate buy and hold investor who's going to rebalance across 13 funds, the way we recommend it, with the 3 funds in fixed income every year, that means on an annual basis, you open your accounts, you figure out which ones are over and which ones are under, and you do some selling and buying to even them all out, and then you let it ride for another year, and you do that throughout the entire process, accumulation and withdrawal. In contrast to 2 fund for life strategy, you open it up and you look at 2 funds, you look at what they're supposed to be, and you do, 1 sale and 1 buy, and you're done.
So, of these strategies, for the people in your life that you've given them, young people you've given guidance, what have you landed on?
A better question would be, what have they landed on?
Good. That's great. Congratulations, by the way. What have they landed on?
I think probably because of their family heritage and their culture, the culture that they inherited and the education they've inherited from a young age. They're all equities and tilted to a little bit small in value. They're all global equities tilted to a little bit small in value. And it varies. Some of them are more comfortable with the idea of investing in something other than the total market, and some of them are less. I have there's one person, young person I've worked with who you've met, Paul, who is very comfortable with the majority of his investments being in all small value as a young person. And he aspires to retire early. And he, based on all the work that he's looked at us doing and all of the things he's learned, he feels like he's got a very, very good chance of doing that as long as he doesn't touch his nest egg and he keeps contributing to it. And I think he does. And then there's other children of mine who are more skittish, a little bit more comfortable with the total market and less comfortable with the idea of being off the beaten path, as it were. So it's a very personal thing, and we will never have an answer for everyone.
Yeah. And Daryl, you too have counseled young people. What have you found to be most comfortable for them?
Well, the ones I've talked to, one in particular, he has chosen to lean a little bit towards a tilted portfolio towards small and value. I'm not sure how much. The others, it's still a little bit of a battle to have them realize that they really should be doing something like this in terms of investing, period.
Yeah.
And paying a little more attention to it.
Yeah.
They are not mine. So they're not my kids.
Yeah.
So
Yeah.
so I'm a little bit loath to push them on it. At least they're doing something, and we'll work that problem as it comes along. One thing I have done is I have sort of given them a little bit of a push or a nudge towards reading a new book that recently came out by some guy named Paul.
And Rich.
And and Rich, yeah. So we'll see what happens when they take a look at that. So
That's terrific. Chris, I cut you off there. Was there more you were going to say about the two funds for life in order to complete?
No, I think
Okay.
I think people probably got the gist of it. And like I said, this slide was more created as self-study for me, but I'm happy to share it with your the people who listen to us and are interested. And who knows, people may have a different take on it or some interesting feedback that's useful.
Yeah, good. It is, I think, the most normal way for people to think about the risk of these is to go to the fine tuning table. It's right there in black and red, the red being the bad years. And the weakness of that presentation is, like Chris noted, it is one series of returns and is only so useful for the future. And yet, when you go back to 1928, which a lot of our work does, it turns out those kinds of series of returns are not unusual. As we've talked about before, the terrible, terrible, terrible years from 1929 through 1938 are virtually the same in total return as from 2000 through 2009. So my belief is there's a ton of interesting stuff to know from the past. What we don't know when we're talking about value, it is really difficult for us to know, now that the world knows about value, will value produce the premium that it has in the past? In a sense, you could ask the same question about stocks. Now that people know stocks make a heck of a lot more than bonds, does that mean that stocks will make less in the future? We don't know what the last 21 years means. We know that the last 21 years, the market has compounded at about 30% less per year than it did the previous 70 years. And so has there been some long-term change in the expected rate of return of equities? We don't know. And our goal is to figure out ways to help you make this decision. I'm sure to some people, today's conversation is still a bit of a head scratcher. So my request, and I know Daryl and Chris feel the same way, send us a question about this in terms of your struggle to pick a portfolio. What I would ask you not to do, only because of our limited time that's available to respond, and we all feel like we want to get back and answer every question, limit questions that have to do with why Chris didn't pick a certain ETF over another one. I recently got a question I've gotten probably 50 times. Why are we recommending the Vanguard small cap value that we are? Why not VBR? Well, VBR, doesn't surprise me, has done better for the last 5 years than the one that we're recommending, or the last 10 years. And but we don't recommend them because They have been the best in the last 5 or 10 years. We recommend them, and you correct me, Chris, if I'm wrong, because they represent access to the asset class that we would like them to be in, which oftentimes means small, more deeply discounted value. And VBR is a very large small cap, average size company with a less value orientation than the ETF that we have in that portfolio. So I
Yeah,
can tell you that.
I like to think of it as, you know, we're designing a portfolio and recommending it to people that it relies for its long-term returns on the premium you get for size and value. And there is hot sauce and there's weak sauce. and so if we recommended VBR, we'd be recommending diluted hot sauce. You know, if you want the spicy meal, if you came, you know, if you came for the spicy meal, which is what that portfolio, the ultimate buy and hold portfolio, is built on, is getting returns from having those spicy ingredients. You want some hot sauce in that bottom left hand corner in the small cap value. You want the spice. Yeah, so you don't want diluted hot sauce.
Well, and the fact is that since the market turned on value, the small cap value that you selected has performed much better than that with the weaker sauce. I mean, that's
Yeah.
the way it's supposed to work.
Hey, Paul, can I'd like to share one other thing here. And this is my version of something Daryl has done before. I'm just grabbing it because it's handier to
great.
me. But you know, Daryl did a whole bunch of work with the telltale charts. And this is just my version of his telltale chart, if you will. But you mentioned a few minutes ago, Paul, this idea that, you know, will value continue to deliver in the future? Will size continue to deliver in the future? So this is a chart of how small value has done relative to the S&P 500 since 1928. And the S&P 500, how it's done relative to the S&P 500 since 1928. So the way we do this is we do the growth of both assets and then we divide one by the other. So if you divide how the S&P 500 grew by itself, you get 1, and that's why it's a straight line. If you divide small cap value by how the S&P 500 was doing, for the first several years, 1928 to around 1943, it underperformed. It was a tough time to be somebody who had committed to that. And then what we see is, you know, over the long haul, there's this kind of reversion to the mean. There's a trend. There's this up and to the right trend, and it catches up and goes ahead, and then lags behind, and then it goes ahead, and then lags behind, and goes ahead. And so you have these long periods you have to wait. But you mentioned a really interesting thing, I think, in the context of this chart. You said, you know, now that these premiums have been published, will they go away? And essentially what you're asking is, will this squiggly line here change from zigzagging around the up and to the right line and forever stay low? Or will it come back up sometime in the future? And I think looking at it this way is kind of interesting. I think it's far more likely that it would come back up somewhere along the way and continue in the pattern it's had for the past almost 100 years. But it could change. It just, you know, with 100 years of that pattern, I'd say looks to me like it's a lot more likely at some point to come back up. And it is more volatile. It's a riskier asset. So there's a lot of people who will not invest in it just because it's got more volatility and more risk associated with it.
This is another great chart from you guys. And what I see here is that I could have invested in 1928 in the small cap value and have thought of myself as in competition with the S&P 500. And about 1963, I am actually back to where the S&P 500 performs. So that is the true story of small cap value. And I
You've
think
been
it's fair
lagged for a long, long time.
Yeah. Yeah. And so at my age, at 77, why do I have small cap value in my portfolio? Because I think that money's going to be used by the next generation. And so I'm not uncomfortable doing it, but I'm also not unaware of this telltale chart. And I really appreciate Daryl, you and Chris for having brought this to our attention. It's not that it hasn't been around, but you know something? I've rarely seen it in all the information that I read through on how the market has performed. So it looks to me like, I haven't added it up, but there's about 33 plus 8 is 41, 59, but 72. 72 years out of that 92 years, you basically kind of broke even with what the S&P 500 would have done for you, which means this is a great investment for a newborn child, right? I mean, wouldn't it be wonderful to be able to put away a little money in small cap value for somebody who might use it 70, 80 years from now?
Well, in the end of this chart, if you were able to stay the course, you're about 10 times greater. You got about 10 times the total return going from 2000 or 1928 to 2020. You ended up with about 10 times as much money, but you had to endure years where it was making you question your judgment. Yeah. You got to be patient.
And speaking of question, go ahead, Daryl. I'm sorry.
First 45 years, you basically broke even. So that
Yep.
that tenfold gain came in the last, whatever that is.
Yeah.
50, 60, almost 60 years. But the great thing about these charts, I think, the telltale charts, is it shows you, and this is, I think this is one of Chris's things, is it shows you that if you want something different, you have to be different. If you put it all in the S&P 500, you're going to get the S&P 500. If you want to have the opportunity to have something bigger or better or different, you've got to be different. And this is a case where small cap value has done that. But it also shows you that it's not a free lunch. This gets back to the behavioral aspects. You have to be willing to endure periods of time, sometimes long periods of time, where you don't outperform. Sometimes you underperform.
And I think another way to come at the percent of your allocation that you would put into small cap value is to think, what allocation are you willing to almost ignore? What percentage of your portfolio can you have invested in an asset class that you hope has very long-term gains, but you're not going to trade out of if it fails to deliver them in 10 years or 20 years? And I think for most people, that's going to be a small bet or a small portion of their total portfolio. It's not going to be 50%, 80% of their portfolio. So even though the back tests say that, the odds of you getting a benefit from it, from taking a big risk early on, are good, because, there's this reversion to the mean, and sometimes it's 8 years, and sometimes it's 18, and sometimes it's 20, and sometimes it's 40. I think the behavioral aspect of it, or what can you stick with, is far more important than just the back test numbers.
And to be fair, that period from 1928 to 1963, as you said, that red line there, that doesn't mean that the S&P 500 didn't do well. It meant that was the relative, that was what we were comparing to.
Or that small cap value didn't do well, right?
Yeah,
It
that's
didn't
true.
do as well as we would have expected, but it did just fine.
It did just as well as the S&P 500.
Yeah.
But you probably tolerated more volatility along the way.
Yeah, probably. Yeah.
And what we don't have here that would be interesting to see at some point is, what is the implication of dollar cost averaging? over that period of time, because we may see a very different story for that young person who during that first 17 years was accumulating lots of cheap small cap value to then see it take off. That was more than just a break even situation.
Absolutely. Yeah. The opportunity to dollar cost average into an underpriced asset or a depressed asset over those years was golden. If somebody was disciplined in their approach or put it on autopilot and ignored it, yeah, you could have done very, very well by basically buying low and then living to see it rise. Yeah.
I think one thing to be careful about when people look at these telltale charts is, and we show small cap value back in the 20s and 30s and 40s, and they think, well, but I couldn't have bought it back then. Well, and that's probably true.
Not easily.
Yeah, but but that's not, in some ways, that's not really the point of the chart. The point of the chart is to show you that, academics have gone back and reconstructed what small cap value returns would have been at that time. And so the point is that this shows you a sequence of small cap value returns that happened. Nobody knew about them specifically or explicitly at the time, but they did happen. And the S&P 500 has the same returns. And so what this really is it's a comparison of a sequence of returns for small cap value and the S&P 500. One shouldn't necessarily, in my opinion, be concerned that I couldn't have bought this back then, because that's not really the point. The point is that this was the sequence that occurred for both these asset classes at this time. And so it represents a possible sequence of relative returns for these two asset classes over time. And again, the point showing that you need to be patient because these things take time.
And by the way, the S&P 500 was also not something you could buy. Yeah. So even that is made up at some level. Well, absolutely. Gentlemen, you've done it again. I started out, I was nervous. I was anxious. How are we going to do this to give folks some opportunity to sort through all of these recommendations? I have a hunch we're going to hear from people on this one. And we're going to take your comments seriously and come back and fine tune this presentation in the future so that we can help you do the best with your investments. But thank you, Daryl. Thank you, Chris. And thanks to all of you who are taking this time out of your life to hopefully improve your financial future. All the best.
I'm delighted to be here today. We've got Mary Beth Franklin, a Social Security expert and author and frequent presenter on the topic of Social Security. And of course, today's session is facilitated by Paul Merriman. Paul is a former board member of the Community Foundation, an incredible communitarian who spent his entire life working in the investment industry, and in retirement decided he wanted to make sure that everyone had access to good, sound financial advice. And he's formed the Merriman Education Foundation, who is our presenting partner for today. As we get things started, I just want to, as we do, Bainbridge Island is located within the Aboriginal territory of the Suquamish tribe. As Chief Seattle said, every part of this soil is sacred in the estimation of my people. Every hillside, every valley, every plain, and every grove has been hallowed by some sad or happy event in days long vanished. So as we begin, we acknowledge that we are on the land that is the Aboriginal territory of the Suquamish people, the people of the clear salt water. Expert fishermen, canoe builders, and basket weavers, the Suquamish live in harmony with the lands and waterways along Washington's Central Salish Sea as they have for thousands of years. Here, the Suquamish live and protect the land and waters of their ancestors for future generations, as promised by the Point Elliott Treaty in 1955. So I want to welcome you all here. As we get started, just want to note that there is a Q&A button in the bottom of your Zoom link. That is a great place to put questions. Paul and Mary Beth will be speaking for a while, but we'll be monitoring that chat. And if we don't get to your question during the course of their conversation, we'll include it at the end. I also wanted to note that this is closed captioned. You should see a little CC live transcript button at the bottom. If you'd like to press that, it should enable the closed captioning if you prefer. So with that, I'm going to turn it over to Paul and welcome you both here. And we're very excited to learn more.
That's great. Thank you, Jim. And thanks to all the folks that have come out. This is the last of the financial literacy series for this year. And I got to tell you, I just think it's been terrific. And to finish the batting cleanup is Mary Beth Franklin. She is amazingly experienced and talented educator, writer. She's a certified financial planner, and in her history of working in the financial industry, it includes working at Kiplinger's. It includes working in Washington, D.C. on Capitol Hill, reporting for the United Press International. And she also has written a terrific book on Social Security. It's called Your Social Security Retirement Benefits. And I was going to donate the entire day to that book just to make sure that I was up to speed. But what happened, unfortunately, was I went to her podcast, and it was absolutely fabulous. I've got to, not only do I recommend that book, but I recommend the podcast. It is entitled The Retirement Repair Shop. And she's interviewing some of the smartest people in the industry. And in fact, there it was, the good, the bad, the ugly about Social Security. It was perfect. And so Mary Beth, thank you so much for joining us and subjecting yourself to all the questions that we're going to have, because interestingly enough, this is the most popular topic in the series. When we had it some years ago, it was by far the most popular. So Jim commented, maybe we should do this every year, but we're lucky to have you here tonight. Thank you. And we asked people for questions. I think half of them, there must have been 100 questions. Half of them or more were all about making a smart decision about when to claim Social Security. So why don't we start at the top and talk about that topic? And of course, as you might expect, those questions came from all sorts of people: divorcees, single people, married people, people with lots of years in between their ages, etc. Let's start with the most common. Is it, and the question would be, is it a common mistake people make, or are people making the right decision when you look at the most common? And that is, I think, the couple, husband and wife, who are claiming, when to start their Social Security. What should they know? What should they do? And what should they be careful not to do?
Well, first of all, Paul, I wanted to thank you and Jim for inviting me on this program and introducing me to your audience. I am equally passionate, as are you, of the importance of financial literacy, particularly when it comes to Social Security. And you're right, it's such a popular topic because, frankly, we have all worked so hard and paid so much for our Social Security benefits in the form of those FICA payroll taxes that have been taking chunks out of our paycheck our entire lives. It's important for people to realize that 7.65% of FICA taxes that come out of our paycheck, and our employers match that amount in taxes, pays not for our future Social Security benefit, but for today's beneficiaries, our parents, our grandparents. And we hope going forward in the future that the younger workers with their payroll taxes will be paying our benefit. Don't think of this as like an IRA. There isn't a file somewhere in Washington with your name, social security number, and a pot of money for you. It doesn't work like that. And I will talk about what your benefit is based on, how you make a decision based on your marital status, your age, frankly, your health, and your other financial resources. The first thing to start with is Social Security benefits are based on your average lifetime earnings, basically your top 35 years of average earnings. That's a piece of the puzzle. The other big piece is your age when you first claim. That is the big determinant of how much you'll get for the rest of your life. Now, a lot of people claim as early as they can at age 62, and that may be appropriate in their situation if they need the money, or if they're in poor health and not likely to live a long time. That can make sense. But they have to realize that if they claim at that earliest age, their Social Security benefits will be reduced by 25% or more for the rest of their lives. It's a permanent reduction. In addition, people who claim benefits before their full retirement age, which depending on your birth year is anywhere between 66 and 67, if you claim those benefits early and you continue to work, having earnings from a job or self-employment, you could temporarily lose some or all of your Social Security benefits if you make too much money. And too much money is about $20,000 a year. So the first thing is, let's look at where the Social Security benefit fits in your overall retirement income strategy. What other sources do you have? Maybe an IRA or 401k, maybe home equity, maybe you're going to work part-time. It's all part of the picture. And let's start with your first question. Married couples, what should we do? I generally suggest that in married couples, now traditionally in American married couples, the man tends to be about 2 years older, tends to make more money, and frankly, tends to die earlier. So the big question that married couples have to ask is, how do I maximize the survivor benefit? Because Social Security is not just a retirement benefit while you're alive, it's a survivor benefit for the spouse that's left behind. And quick math lesson, a spousal benefit, if I am a working woman, I'm entitled to my own retirement benefit on my own earnings record. I'm also married to somebody who's entitled to Social Security. So technically, I'm entitled to a spousal benefit that's worth half of my husband's benefit. I don't get both. I get the higher of the two benefits, and it depends on how old I am when I was claiming. But if he dies first, which is likely, I am now going to step up to a survivor benefit that's worth 100% of what he was getting. And at that point, my smaller benefit goes away. So how do we make the most of that survivor benefit? I suggest that in a typical married couple, we have one spouse that has the bigger benefit, which tends to be the husband. Have him wait as long as possible, up until age 70, to get the biggest benefit possible. Because for every year he postpones claiming beyond his full retirement age, up until age 70, he's getting an extra 8% a year. That's a smoking hot deal. So if his full retirement age benefit at 66 is, say, $2,000 a month, and he waits till 70, he's going to get 32% more, $2,640 a month. And the difference between claiming as soon as possible, in his case, at 62, when he would get 75% of his benefit, versus waiting as long as possible up until age 70 to get 132% of his benefit. The difference is he can increase his monthly Social Security benefits by 76% for the rest of his life. Now, as a certified financial planner, there is no investment that I can recommend that is going to increase by 76% over an 8-year period. Smoking hot deal. But, so let's say that's what the husband does. Now, what does the wife do? Again, it depends. Let's say she's one of those women that hasn't worked her whole life. Maybe she stayed home and raised kids part of the time. Her benefit's relatively small. And let's say she's not working right now. She may want to go ahead and claim her Social Security benefits as early as 62. I know that sounds like heresy. I just said she's going to get a cut. Why would I do that? Well, it brings some cash flow into the household, takes away a bit of the sting of having the husband wait longer. She doesn't have to worry about an earnings restriction because she's not working. And here's the secret. Even though she collects her own reduced retirement benefits early at 62, and those retirement benefits are reduced for the rest of their lives, has no impact on her survivor benefit. If she is at least full retirement age, when she is widowed, she will step up to 100% of what her husband was collecting, including those delayed retirement credits, and then her smaller benefit goes away. Now that works for the wife who's not a big earner. Let's say we have another dual income couple and the wife is still working and a substantial earner. She will probably want to wait till full retirement age to claim when the earnings restrictions go away. But otherwise, that same strategy may hold. Have one wait till 70, have one claim at full retirement age.
So is it not true then, when they wait until that age 70 and the government gives us increases and inflationary increases, that increase is going to be on a bigger number? I mean, everything becomes a bigger number growing. It's the compounding effect that makes it bigger. And of course, we don't know what that inflationary rate is going to be, but it is a wonderful thing to do if they can do it. But what are the conditions that you see that people aren't able to do that or don't think they can do it, but you show them how they can do it?
And first of all, I'm glad you brought out that point. The example I was giving of that extra 8% a year is simply the delayed retirement credit, the bonus you get for waiting up until age 70. In addition, every year that there is a cost of living adjustment awarded, that also increases your future benefit. So if you have waited to get the biggest benefit possible, and then there's a cost of living adjustment, that percentage, that cost of living adjustment is going to be applied to a bigger dollar base, which means your annual increase is going to be better. And speaking of cost of living adjustment, that's really in the news. For 2022, Social Security benefits increased by 5.9%. Now that is the biggest cost of living adjustment we have seen in 40 years. I am hearing from some people, wow, such a big COLA. I guess I should claim Social Security benefits now to cash in on that big cost of living adjustment. Whoa, you don't need to do that. If you are 62 years or older right now in 2022, that means you are eligible for Social Security whether or not you have claimed it. And if you are eligible for Social Security, every cost of living adjustment that is awarded between the times you're 62 up to the age you claim is baked into your future benefit. Now, if you're younger than 62, nothing you can do about it. You're not going to get that 5.9% COLA baked into your future benefit. But guess what? The way inflation is going, next year's COLA might be even bigger. And if you're 62 next year, that cost of living adjustment will be included in your future benefit.
And can that spouse that did not have an income late in their career, what would they have to do to earn enough credits that they would actually earn some Social Security rather than having the half of the husband's?
Well, great point. What determines your Social Security benefits? Your top 35 years of lifetime earnings. Let's say I only have 20 years of earnings because I was staying home for 15 raising my kids. Social Security is still going to divide by 35. That means I'm going to have 20 years of earnings and 15 years of zeros. But and when I average that out, it's going to be a lower average lifetime earning and consequently a lower Social Security benefit. But every year that I continue to work, regardless of my age, even if I'm beyond my full retirement age and I am already collecting Social Security benefits, every year that I work adds to my earnings record. And if it has replaced one of those 0 years, or my current earnings are higher than a previous year that was used in the original calculation, my future benefits will automatically increase. So that's a great message, even for people who maybe have a modest Social Security benefit and they're planning to retire, but maybe they want to work part-time. As long as you make about $5,000 a year, you're getting your full maximum 4 credits a year. You need a minimum of 40 credits, essentially 10 years of work in the private sector, to be eligible for Social Security. But the amount you receive is based on your average lifetime earnings over the top 35 years and your age at the time you claim. Oh, Paul, I'm sorry, you're on mute. I can't hear you.
Sorry. The dogs were barking. The excuses that people come up with for taking it early. What is the legitimate? If they came in and said, I'm only going to live 3 more years or 5 more years, that maybe that would be forgivable. But what are the real excuses that that you think are legitimate for taking it early?
Well, I say that the idea of delaying claiming your Social Security benefits with the idea that it would be worth more later is a bit like the lottery. You must be present to win. If you don't think you're going to be around a long time, that perhaps delaying your Social Security benefit is not a good idea. But frankly, most Americans underestimate how long they'll live. On average, a 65-year-old man and woman going to live to about 85, and half of all Americans are going to live longer than that. If you're part of a married couple, you have a 25% chance that one of you is going to live into your 90s. And again, there's the idea of how do I protect the spouse that's left behind? But certainly, let's say I was one of those people that during the COVID pandemic, my job disappeared. I need the money. If you need the money, go ahead and take it. That's what it's there for. Do not feel embarrassed about that. But if you say, gee, I hear Social Security is going broke in a few years, I think I better grab it now while I can. Well, I never think claiming Social Security benefits early out of fear is a legitimate reason. It's a bit like saying, I have all this money in the stock market and the market just went down 30%. Gee, I don't like that. I'm going to go all to cash. The only thing I've done there is guarantee that I have locked in the loss. Same thing with claiming Social Security benefits early because you're afraid the system is going bankrupt. You have just guaranteed you locked in the loss. Now, is it going to go bankrupt? No. Let me define terms here. Shorthand, those FICA taxes that we've been paying is what pay Social Security benefits. About 40 years ago, 1983, Social Security was in real trouble. And that's when there was all sorts of reforms that were implemented, including what was very smart. The Social Security Commission back then said, you know, this huge baby boomer generation of over 76 million people are going to start retiring around 2010. Why don't we start collecting more FICA taxes now in the early 80s and stockpile that money for the days when the baby boomers start retiring? Those stockpiles, those reserves are called the trust funds. Well, for nearly 40 years, those trust funds have been growing and growing and growing, over $1 trillion of the trust funds. Around 2010, as predicted, 2 things happened. Baby boomers started to retire, and we had this huge recession. A lot of people lost their jobs. They weren't paying FICA taxes. And so for the first time in 2010, the FICA tax revenues alone were not sufficient to pay Social Security benefits. So the government started tapping the interest that had been building up on those trust funds to help pay the benefits. That worked fine till about 2021. Whoa, we had a pandemic. A lot of other people lost their jobs, and a lot more people, because of the aging the baby boomers, started to retire. So for the first time, FICA taxes alone and interest on the trust funds alone were not enough to pay Social Security benefits. So for the first time, the government started dipping into the principal of those Social Security trust funds. And they will continue dipping into those trust funds until they run dry, expected sometime around 2034 if Congress does nothing, which I don't think will happen. In that worst case scenario of Congress doing nothing, what does it mean when the trust funds go dry? It means there would be enough money from ongoing FICA taxes to pay about 75% of promised benefits. It's not going bankrupt, but nobody, you, me, or anybody in this audience will be satisfied with 75% of promised Social Security benefits, and Congress knows this. So senior citizens are the largest, most powerful voting bloc in the country. There are more than 70 million people receiving Social Security benefits. They will fix this, and it is not rocket science. I will give you two examples. The FICA taxes we pay, a portion of it, 6.2%, actually funds Social Security. The other piece funds Medicare. If we gradually raise that FICA tax by 0.1% every year for 25 years, that solves about the other half of the funding problem. If at the same time you gradually raise the full retirement age, which will be 67 for people born in 1960 or later, if you gradually increase that over decades to 70, and I'm talking for today's 2-year-olds, they're going to live to 120, they'll get used to it. Those two things alone would solve the long-term financing problem. And here's one more piece that's so fascinating from Social Security history. Back in 1983, the Social Security Commission said, as long as 95% of US wages, 90% of US wages were taxed for FICA purposes to fund Social Security would never, ever run out of money. But when we're taxed to pay Social Security taxes, we only pay up to a certain level of wages. This year, it's $147,000. If you make $147,000 or less, you pay FICA taxes on all of your wages. If you make more than that, you do not pay Social Security taxes on the excess. So many people are making so much more than $147,000 a year that the amount of US wages being taxed for FICA purposes has dropped to 83% of US wages instead of 90%. If that was gradually raised, again, over decades, solves the problem forever. So there are solutions out there. These are not mathematical problems, they're political problems. And I think each one of us as citizens need to contact our congressmen and senators and say, we know this is a future problem. We give you our permission to talk about it. Because from the politician standpoint, they have no good news. They're either going to say to you, hey, I'm going to raise your taxes, I'm going to cut your benefits, or I'm going to do both. They're afraid to talk about it. We know it's got to be done. And the longer leadway you give us, like in 1983, the last big reforms, nearly 40 years ago, are not fully implemented yet. The last piece, raising the full retirement age to 67, does not kick into 2027.
So you're not worried.
I'm not worried.
That's great. And the people then that are panicking and taking money immediately are actually taking a risk themselves in taking that step. So you're a financial planner and an expert on Social Security. And I want to get back to these claiming strategies in a minute here, but I am curious, do you actually have a regular practice as a CFP, or do you specialize in Social Security to help people who have particularly difficult situations?
I have a very interesting business model. Yes, I am a certified financial planner. I'm also a lifelong journalist over 40 years. My focus is on financial education. So I write a weekly column for Investment News. As you can see this banner behind me, they pay me to write a weekly column answering questions about Social Security for financial advisors and their clients. And because I do a lot of education like this in radio and television programs, lots of consumers contact me with their individual questions. I do not charge for that advice, but I say to them, here's your devil's bargain. I'm going to write about it. Yeah. Your only choice is I quote you or I don't quote you. But I consider it field research because It lets me know where the confusion is among the general public, where their questions are, and where I can be most useful in focusing my columns. So yes, I do answer people's questions. People can Google me, look up Mary Beth Franklin, you'll find how to reach me through investment news. And if it's a really tough questions, there are some excellent services that charge some modest fees that can really help people untangle complicated Social Security situations.
Can we talk about those people for a minute since you brought it up? Because the problem so many of us have is how do we qualify the how good they are? I mean, there are people who do workshops for the public, and they talk about Social Security because it draws a lot of people. And then what they, in many cases, not all, in many cases, what they really want to do is help them solve their Social Security problems so they can sell them an annuity. And I'm not saying annuities are evil, but it's a master plan because it's a very profitable business. But how would a person, what designation would you look to know that a person was a specialist, or would any certified financial planner be up to speed that would qualify for your definition of a specialist?
Well, there is an organization called the National Social Security Association. I'm glancing to the certificate on my wall because I do have that certificate. And you can go to their website, National Social Security Association, and they'll have listings of professionals in your geographic area that can help you. Some of them are certified financial advisors. Some of them are registered investment advisors. Some of them are people who do not sell any kind of financial products, but just help with Social Security decisions. There's another group I like a lot. One is called Social Security Advisors. That's advisors with an O, ADVISORS.com. They do charge modest fees, like $100 for this, $100 for that. But I send people to them who have had problems. Gee, I filed for this benefit, but I realized I got bad advice and I should have gotten some retroactive benefits. Can you help me? When it's a complicated situation like that, I send them to the experts. There are other sites. One is called covisum.com, COVISUM.com. Another one is called Social Security Analyzer.com. Both of these have consumer-friendly sites as well as sites for financial advisors that can help people based on their personal situation, their marital status, the amount of their individual Social Security benefits, find the appropriate claiming strategy for that couple or that individual. And I feel like for such a important decision, I really think deciding when and how to claim Social Security benefits is probably one of the most important retirement decisions people make. I think it might be worth spending a few bucks. Now, AARP.org also has a free Social Security claiming strategy calculator. That might be a good place to start. It used to be a lot more complicated. There were a lot of different claiming strategies that particularly married people could use. A lot of those have gone away, but there is one remaining strategy depending on when you were born. And write this date down, January 1st, 1954. If you were born on or before that date, and you are currently married, or you are divorced after being married at least 10 years, it is possible that you can exercise a very valuable claiming strategy called restricting a claim to spousal benefits. It essentially allows you to collect benefits as a spouse, that 50% of your husband's or wife's full retirement age benefit, while your own retirement benefit continues to grow by 8% a year. But you can only do this if you were born before 1954. That means this year in 2022, you have to be 69 by the end of this year, or So basically there's 2 birth years that can still use this. If you were born in 1952 or 1953, you can do this. And I'm going to give you an example from my own life. I was born in December 1954, too late to do anything fancy. But my husband was born in 1952. So when I reached my full retirement age of 66, I filed for my Social Security benefits. And again, you're probably saying, oh, the Social Security guru didn't wait. The reason I filed at my full retirement age, 2 reasons. I continued to work, but the earnings restrictions went away once I reached my full retirement age. And now it triggered a spousal benefit for my husband. At that point, my husband, who was born in 1952, could file online, just like I did at ssa.gov. But because it recognized his birth year was before January 1st, 1954, and that he was married, the question says, if you are entitled to your own Social Security benefits and that as a spouse, would you like to collect spousal benefits only? And he said yes. And he was able to collect half of my full retirement age benefit amount. Now that's in addition to what I was receiving. And when he turned 70, which was just a few weeks ago, he filed again online, opening a new request for benefits because now he was going to file on his own retirement record. And he got that full benefit, the extra 32% in delayed retirement credits, which just came last week. He was very happy. Now, should he predecease me, which actuarially is likely, I would then step up to his larger survivor benefit and my own smaller benefit would go away. But we could only do this because he was born before 1954.
So I am back, I think. Am I working?
I just talked right through you, Paul.
That's great. I love it. That
Brilliantly
made my day.
done, by the way. Yes.
Okay. So I ran into a fellow who's been married several times. And he's not as old as I am, but he's close. And his ex-wives are older. And they are all getting a Social Security check based on his earnings. Is that the way it works?
It sure is. I like to call that the Johnny Carson rule, who was married 4 times, all to women that began with a J, Joanne, etc. This is how it works. And now, understandably, Social Security is a very confusing program. It has more than 2,700 rules, and I promise not to go through all of them. But a lot of them are exceptions, and a lot of the exceptions apply to divorced spouses. So let's go through some basics. What does it take to be an eligible divorced spouse to be able to claim benefits on an ex? First, you must be married at least 10 years. It can't be 9 years, 11 months, and 29 days. It's got to be 10 years plus. So think of it this way. There must be at least a decade between I do and I don't. And you tell every one of your friends who's thinking about a divorce, stick in there for 10 years and make sure their divorce attorney knows that too. Now, in addition, assuming you were married at least 10 years, divorced, and you're currently single. Now, you may have married somebody else in between, but that subsequent marriage ended in death or divorce. You are currently single. And you and your ex each have to be at least 62 years old. In other words, eligible for Social Security benefits. Now, in general, say I'm the ex-wife, when I claim my benefits, I am going to get the higher of my own benefit or half of my ex benefits. Let's say my ex's benefits are $3,000 a month. Half of that is $1,500. If I never work a day in my life, I file for benefits of full retirement age, I'm going to get that $1,500. But let's say I have my own earnings record and my own benefit is $2,000 a month. That's what I'm going to get. I'm never going to get a spousal benefit because my own retirement benefit is bigger. I'll get the bigger of the two. Now, what happens if I was born before 1954? I can do just like the married couple could do. If I wait till my full retirement age or older, and I was born before 1954, I can say to Social Security, give me half of his benefit. give me half of her benefit. They don't even need to know about it. You all just go through the Social Security Administration. You prove that you are who you say you are. You know, you have that marriage license, the divorce decree, proving that you were married at least 10 years and you are currently single to collect on a living ex. Now, what happens if it was a really ugly divorce? And maybe that ex-spouse said, I am never going to retire and you are never going to get a dime of my Social Security. Well, Congress thought that might be a problem. So in addition to being married at least 10 years, divorced and currently single, if you are divorced at least 2 years and you're both at least 62 years old, you can collect on your ex, even if your ex has not claimed his or her benefit. It's known as being an independently entitled spouse. Married couples can't do that. Like in my case, I had to claim Social Security in order to trigger a spousal benefit from my husband. If we were divorced, he could have collected on me even if I hadn't collected. Now, for all those sad divorced spouses who say, gee, I was born after January 1st, 1954, I can't do anything fancy, except if your ex dies. Now you are an eligible surviving ex-spouse. And here's where the rules get crazy. I told you, you must be married at least 10 years, divorced, currently single to collect on a living ex. But if you wait till 60 or later to remarry, you can collect on a dead spouse, even if you're married to somebody else. So here are the rules. You must have at least a decade between I do and I don't. And if you're going to take a second trip down the aisle, wait till 60 to do it. Now, here's a crazy scenario. Here's your Johnny Carson example. We have John and Mary are married for 10 years. They get divorced. Mary remains single. Then John marries his secretary, Susie, and they're married for 10 years and they get divorced and Susie remains single. Then John's one of those guys who doesn't really like to be alone and he meets Tiffany, and Tiffany's 30 years old and they fall madly in love and get married. And now they have a little boy, Johnny, he's 2 years old, and Big John drops dead. Who gets benefits? Everybody gets benefits. Oh. The first ex-wife, married at least 10 years before divorcing, gets 100% of John's survivor benefit. She does not have to share 100% of what he was collecting when he died. So does the second ex-wife, married at least 10 years, divorced. She gets 100%. It's 200%. Little Johnny, he's 2 years old, he gets 75% every month until he turns 18. And Tiffany, his mom, gets 75% every month until little Johnny turns 16. So when you worry about the trust funds going under, I'd worry more about the divorce rules.
Okay. You know, it's interesting. In your book, you say that we cannot get advice from Social Security. And yet I understand that they do give some advice, or maybe they're not supposed to, but they do. Where is the line where Social Security can help people make decisions that that somebody didn't have the money to pay an expert and felt that Social Security should help them do that? Where's the line?
Well, keep in mind, let's put this in context. Social Security has more than 60,000 employees, a lot of really hardworking, dedicated individuals who had been working from their kitchen tables for the last 2.5 years. The field offices just reopened April 7th after the pandemic. Now, what they're supposed to tell you and what they actually tell you, a lot of them go that extra mile and they're going to say, listen, honey, this is what I think you should do. A lot of them have been in that job for 30 years and the philosophy has changed. And in the old days, the idea was grab that money as soon as you can. There wasn't a lot of this, let's coordinate our claiming strategy, because frankly, a lot of the law changes that made those coordinated strategies make sense weren't enacted until the year 2000. So if you have older workers who had been working and going on what they used to know, the advice they give you may not be pertinent or relevant. My feeling is Social Security overworked people under a time crunch. Their job is to process your application. Your job is to figure out the best time to claim those benefits. And if you need help to get it, whether it's through a free calculator like at aarp.org, or to pay someone a modest fee to help you come up with an optimum claiming strategy, I think it's worth investing some of your time and possibly some of your money to come up with what is the best solution for you. For example, a good friend of mine, married couple, situation where the husband was old enough to claim a spousal benefit, and they went to the Social Security, and the rep tried to talk them out of that strategy, saying, oh, no, you should both claim at 62, you'll get a lot more money. No, we don't want to do that. So not only do you need to come up with the appropriate strategy for you, you have to have the confidence to stick to your guns if somebody's pushing back.
So going back to these people who wrote in and they wanted to help figuring out what their smart steps would be in terms of claiming Social Security. We've talked about the couple, we've talked about the divorcee. Is there anything special for the individual that they should have in mind as they make that decision?
Well, individual, which I would define as either someone who's never been married or someone who had been married for fewer than 10 years before divorcing and therefore does not qualify as an eligible divorce spouse. Basically, whenever you file for benefits, your age at the time you first claim is going to determine how much you get. So I usually say, certainly, if you're still working, you want to wait until at least your full retirement age to claim benefits when the earnings restrictions go away. Does it make sense for a single person to delay up until age 70? That is a tougher question and really very dependent on your health and your other income sources. Because should you die before you claim, if you're married, your surviving spouse is likely to get a survivor benefit. If I'm single and I die before I claim Social Security, nobody gets that benefit. I don't have a survivor by definition. The money goes back into the Social Security pool for other beneficiaries. So a lot of times for single people, it makes sense to go ahead and claim at full retirement age, even if you don't need the money, and bank it. If nothing else, it will help pay your Medicare premiums, which are deducted directly from your Social Security benefits. Now, if that larger check waiting up until age 70 is going to make a big difference in your retirement income, well, then it's probably worth waiting. You really have to look at your overall retirement income picture and what's going to be right for you.
Mary Beth, I did love the interview that you had with Wade Pfau. He is definitely, not only are you one of the sharpest, he too is one of the sharpest people in our industry. And I hope that our viewers tonight will go to the Retirement Repair Shop podcast that you do and watch the interview with Wade Pfau, because I think it will give people a really great overview of the different ways of accessing your money in retirement. I thought it was wonderful.
Right, because Wade is one of the top researchers on the changing retirement. Our big issue is longevity. We are living so much longer than previous generations. We really do need to plan for at least a 30-year retirement. And we don't have those traditional guaranteed sources of income like a pension that perhaps our parents or grandparents did. So we have to figure out how to save for our retirement while we're working through our 401ks and IRAs. And then the harder part becomes, how do we take that pot of money and stretch it out over 30 years in a way that will last as long as we do? We don't want to run out of money before we run out of breath, but we also don't want to deny ourselves unnecessarily by scrimping and saving. Some retirees have a really hard time of making that mental switch from I'm saving, I'm saving, I'm saving, I'm saving. Oh, I'm supposed to spend. I'm afraid to spend. How much can I spend? So he talks about what works. And in some cases, maybe if you don't have a pension, and in addition to your Social Security, which is guaranteed income, maybe you do want some sort of annuity where you give a chunk of money to an insurance company that will pay you a monthly payment or quarterly payment or whatever for the rest of your life, as long as you live. my philosophy is people should get a rough idea of what their fixed costs are in retirement. How much does it cost to keep a roof over your head, food in your fridge, pay your taxes, your health insurance, everything it takes to live? And then I like to match it up with what are my guaranteed source of income. I've got Social Security, that covers a chunk of it. Maybe I have a pension or an annuity, that covers another chunk. If my fixed costs are covered, I'm probably okay. And then I can just draw down my investments for those discretionary funds. If my fixed costs aren't covered, I might want to take some of those invested assets and maybe buy an annuity to fill in that gap. Or maybe I got a lot of equity tied up in my home. Maybe I want to figure out, how do I access that? You know, some people would take out a home equity loan. The problem is in retirement, that's got to be paid back. And if you're on your fixed income, that can get tough. It can also be harder to qualify for a home equity loan if you're no longer working and don't have that paycheck. Some people turn to a reverse mortgage. And I know that's very controversial in some areas, but the idea is for people who are homeowners, at least 62 years old and have a lot of equity in their home, they can actually borrow against that home. You keep your title, you keep your ownership, you must keep it up in terms of insurance and taxes and maintaining it, but you can draw money out either on a regular basis or line of credit. That could be valuable going forward. And what's so important is any of those distributions are tax-free. And we're finding that so many retirees are shocked of how much they're paying in taxes in retirement, a lot more than they thought they were. And when their income is higher and they're paying these higher income taxes, often they're paying more for Medicare premiums as well, because that is also tied to your income in retirement. So we like to look at ways of how can people who are nearing or even in retirement get some of their taxable money, their retirement account money or other money into a tax-free column. For some people, it's a good idea, particularly maybe in those years between when they retire and their income from working drops, and maybe before they actually claim Social Security at 70, they may have several years of lower income. That could be a great time to convert some of your traditional IRA money to a Roth IRA. What does that mean? It means I would pay taxes at the time I take money out of my traditional IRA and convert it to a Roth, but now I've created a pot of tax-free money for the future. And let's say I'm a few years down the road and I look at my income taxes and I look at my Medicare premiums and I think, wow, I was $5,000 over, that pushed me into the next income tax bracket or pushed me into a higher Medicare premium. And if I had just taken that $5,000 out of my tax-free Roth IRA instead of my regular retirement account, I could have lowered my income taxes and my Medicare premiums. It gets complicated. That's when it's really helpful to have a financial planner, particularly one that specializes in retirement income planning, because just like your working years, it's not what you make, it's what you keep, even more so in retirement.
Since you bring in the financial planner here into the discussion, the first of the series this month was about, do I need an advisor, financial planner? And I would really like your perspective. We talked about hourly people and people who get paid by percentage of assets or commissions, but what advice, general advice, would you give on how to find a planner and use a planner to make these very important life decisions that doesn't require you to tie your money up and pay somebody 1% a year?
Right. I think, for so many Americans who the bulk of their investments are in their 401k plans at work, that pretty much can serve them in their working years. But I think before you get to retirement, sort of that red zone of about 5 years before you retire, is a good time to have a fiscal checkup. How am I doing? And what am I going to do when I leave this job and this paycheck and I take these lifetime savings? What do I do with them? That's where it can be really helpful, even if you're just paying a financial planner as a one-time create a retirement income plan for me. You can find people that will do that, because in the old days, we used to think of financial planning or wealth management strictly from an investment standpoint. You know, this is a person who's going to put my money in stocks and bonds or whatever I need and maybe sell me insurance. Well, all those things have become very accessible from a consumer level to do their own. I can open up a Schwab account or go to Fidelity or Vanguard or whatever and do what I want as far as my investment goes. But I think a holistic financial planner that can look at what is your insurance situation? What happens if you die? What are you leaving for your spouse? Are there survivor benefits on your pension or your IRA? How are they titled? How do you plan to leave money to your kids? Do you need long-term care insurance? What if you might need long-term care and you can't get long-term care insurance because it's too expensive or you medically don't qualify? What are other alternatives for that? I think that's the real value of a financial planner, looking holistically of, I'm going to enter this new phase of life of retirement that holds these wonderful possibilities. And, you know, certainly I can only buy the life experiences that I can afford to buy based on what I've saved throughout my life, but they can make sure all the gaps are filled and they ask the questions that individuals might not think to ask. If I'm no longer working, I probably don't need disability insurance anymore, but I might need long-term care insurance, or I might need help as I sign up for Medicare to decide, do I need a Medigap supplemental policy, or do I need, you know, a Medicare Advantage plan, which tends to be cheaper and all-inclusive, but limits me to a certain network of providers. Those are the important kind of decisions I need help with. And sometimes you can find one person that will do it all. Sometimes you'll find that one person that can refer you out to other people, like CPAs, tax attorneys, estate planning attorneys, whatever you need. It's important to have all the right documents in order, because you don't want to be a burden on your family, either if you become ill towards the end of your life and need care, or you leave a financial mess to your kids because you never took the time to think it through. This is, you know, I think part of retirement, and I'm getting there at that phase myself too, to make sure all of the T's are crossed and the I's are dotted, so I can go off and enjoy my future retirement, and I know my family's taking care of the best of my ability.
Well, that's wonderful help, wonderful advice. I don't see that we have any questions coming in. Jim, there you go. Anything?
Well, I think we've done a great job of answering the questions that we've gotten. I do want to clarify, if you are one of the people who asked that question and you don't feel like it was sufficiently answered, please let us know again, and I'll bring that back up.
Let me jump into another topic since we have time.
Yeah.
The one thing I want to stress is that retirement benefits and survivor benefits are two different pots of money. And if you are entitled to both, let's say you're married and you'll have your own retirement benefit, and now you're widowed. Okay, I've got a retirement benefit and I potentially have a survivor benefit. Depending on my age and my situation, I may be able to claim one type of benefit first and then switch to the other bigger benefit later. I can do it in either order that benefits me. And it doesn't matter when I'm born. There's no birth date restriction on this. So I'm going to give you two examples. Let's say we have a widow. She's 62. She's young. She's not working. And she has her own retirement benefit, but it's smaller than her potential survivor benefit. And remember, a survivor benefit is worth 100% of what her late husband was collecting or entitled to collect when he died. So in her case,
is there any restriction on how long they were married?
No, well, to collect benefits as a survivor, you must have been married at least 9 months and at time of death. Okay. To collect benefits as a spouse on a living spouse, let's say I've never worked, my husband has a Social Security benefit, I have to be married at least a year. To collect benefits as a divorced spouse, I have to be married at least 10 years and currently single. And to collect as a divorced surviving spouse, 10 years and wait until at least 60 to remarry. Quick, repeat that. So let's say we have this young widow, her benefit's smaller, her own retirement benefit. She may want to go ahead and claim her own retirement benefit as early as age 62, even though it's permanently reduced. She doesn't have to worry about the earnings restriction because she's not working. And even though her retirement benefits are permanently reduced, once she gets to her full retirement age, doesn't matter. She can now switch to her full survivor benefits and get the full survivor benefits for the rest of her life. Now let's switch the scenario. Maybe it's a husband. He lost his wife to breast cancer. He's still working. He's entitled to both his retirement benefit and a survivor benefit. His retirement benefit's probably bigger. He probably at his full retirement age wants to collect the survivor benefit. A survivor benefit is worth the maximum amount if you collect it at your full retirement age. It does not continue to grow by 8% a year. That's only a retirement benefit. So he, the surviving widower, would collect his survivor benefit his full retirement age, even if he's working, no earnings test after full retirement age. In the meantime, his own retirement benefit continues to grow by 8% a year. And at age 70, he switches to his full survivor benefit.
Wow, thank you. That's, I expect everyone to pass this test, right?
Well, now wait a minute, Jim. They don't have to pass the test because I happen to know that Mary Beth allows an open book test. All you have to do is have a copy of her
book.
There you go.
And I'll tell you, it is terrific. It includes all of this information.
Well, speaking of which, how do you buy my book? It's an ebook, which means you go to the website, which is www.maximizingsocialsecuritybenefits.com. It's $29.95. It's updated every year. That's the 2022 version. You pay for it and it is downloaded and you can print it out if you like. It's only 50 pages because I don't think anyone should have to read more than 50 pages about Social Security. And guess what? You don't have to read 50 pages. You can go right to the section that says married, divorced, single, families with children. Speaking of children, did you know, as we talked about the little case of John and Susie and Mary and Tiffany and little Johnny, that it makes sense if John the father dies and there's a minor dependent child like Johnny, that Johnny would get survivor benefits every month until he turns 18. But do you know if John the father merely collects retirement benefits, he's alive, and he has a minor dependent child like Johnny, Johnny gets dependent benefits too, worth 50% of dad's full retirement age benefit every month until Johnny turns 18. I used to call that the Viagra College Fund because we had so many older dads remarrying and having younger families. You know, that could be a reason that maybe an older father who's no longer working might want to claim early at 62 to trigger a benefit for a dependent child who can only get benefits until the child is 18. If that kid is, 14 and dad's 62, he may want to claim now because if dad waits till 66, the kid's going to be 18 and not be able to get benefits. So that plays in, gee, if I have a minor dependent child, and guess what? There are so many grandparents raising grandchildren. In some cases, those grandchildren would qualify for benefits. If they live with the grandparents, they are tax dependents and either the child's parents are deceased or disabled. So it's a little more complicated, but quite possible. A child, a dependent child, is considered a biological child, an adopted child, a stepchild, and in some cases, a grandchild. This same rule, dependent benefits, also applies if you have a permanently disabled adult child who was disabled before the age of 22. If dad claims a retirement benefit, there's a disabled adult child in the household, that child gets half of dad's benefits every month for the rest of that child's life. It's tricky when you have a dependent adult disabled child because they are likely getting other benefits like supplemental security insurance and maybe Medicaid and food stamps and housing allowances. When they automatically get a Social Security benefit as a dependent on a parent's benefit, it can affect their income tested other benefits. So that's where you really want to talk to a disability attorney who is well versed in this. There are ways to set up a trust for that disabled child, to have the Social Security benefit go directly into the trust, and only enough money comes out to stay under the monthly or annual income limitations.
Mhm.
So, Jim, did you have a question?
I did actually. There's a couple more in the chat that I was
Oh,
gonna.
great.
I was
Good.
gonna ask about. So one question. Looking at your crystal ball, Mary Beth, do you think the Trust Act is a good step toward resolving the Social Security shortfall, and why is that?
I'm sorry, the Trust Act. I'm not sure what you mean.
All right. Well, pause on that one. Let me let the two of you talk. I'll come back to the Trust Act. The other question I have. So you've got Paul, expert in investments, Mary Beth, expert in Social Security. Is there any benefit to collecting your Social Security early and investing that can you do better if you take those assets yourself? You do better in those investments than the government escalation factor equation would.
Well, let me, I'll weigh in, and then we'll let Paul, the investment expert, weigh in as well. Let's look at the delayed retirement credits, 8% per year. That applies for every year you postpone benefits beyond your full retirement age up until age 70. So if my full retirement age is 66, I can theoretically get 4 years at 8% a year for 32% increase. I think if you're saying, if I take the money and invest it on my own, well, I could put it in the stock market and maybe I make 30%, maybe I lose 30%. I don't think that's a fair comparison. I think I need to say, if I took this money and invested it in a guaranteed investment, how would that compare to Social Security? Well, for the past decade or so, we have been living in a zero interest rate environment. And although interest rates are now starting to creep up, they're still below historical averages. While on the other hand, the government is guaranteeing us 8% a year. Let me tell you a little history of how we got to this 8% a year. May I? Do we have time for a short story?
Yes.
Yeah.
Back in 1983, when Social Security was really going broke, and Congress knew it, and they didn't know what to do. And as dysfunctional as our current Congress is, it was no picnic back in 1984, 83. To refresh your memory, we had Ronald Reagan in the White House, the great Republican communicator, and we had Tip O'Neill, the great Democrat of Massachusetts, as Speaker of the House. Two political lions who did not see eye to eye on anything, but they knew Social Security was so important, and more importantly, old people voted. So they did what they usually do in Washington when you have a really tough problem. You punt. You appoint a bipartisan commission to come up with a solution and recommend a solution to Congress for an up and down vote. And that's what they did in 1983. And they appointed a guy that no one had ever heard of to lead this commission, but you may remember him, Alan Greenspan. Long before he was chairman of the Federal Reserve Board, he was head of the bipartisan Social Security Commission. And one of the many smart things he said was, this is back in 1983, everybody is collecting Social Security at 62, but Americans are living so much longer. What can we do to incentivize Americans to delay benefits until they can get a bigger benefit later? Well, then they started talking about these delayed retirement credits. And I explained that they're 8% a year. They weren't 8% a year in 1983. They were 3% a year. But the only problem was interest rates were 18%. Who in their right mind would delay claiming Social Security for a mere 3%? You could stick the money under your mattress and do better. So the commission said, let's gradually raise the delayed retirement credit by 0.5 percentage point a year until it gets to what? What do you think, guys? 8%? Sounds pretty conservative to me. After all, interest rates are 18%. Okay, we're going to cap it off at 8%, and we will apply it to anyone born in 1943 or later when they reach their full retirement age. So here's a math question. 1943 plus a full retirement age of 66 adds up to 2009. What else happened in 2009? greatest stock market crash since the Great Depression. And for the first time, the government was saying, I'll give you an 8% a year to wait. That's the reason people talk about delaying Social Security benefits until they're worth more. Now, as I said, interest rates are starting to creep up. I think if interest rates got to 5 or 6%, at that point, I might say, you know, probably not worth it for me to take my chances. Maybe I'll claim Social Security at full retirement age. But until it gets to that point, 8% a year guaranteed is a smoking hot deal. All yours, Paul.
Well, and think about the advantages to a surviving spouse. I mean, if a married couple, that's pretty selfish if they're in any chance of living a long time. Here's the anecdotal evidence I have, having been around the business for about 60 years. The people who take their Social Security and are going to invest and make more money, I don't think typically do what they thought they were going to do. And in fact, on average, they're going to come out behind. That's my experience from people who in essence have a great idea. And so often, I mean, it's not so different than people thinking they were back when interest rates were 18 and thinking that 8 was going to be cheap.
Right.
Recency bias costs people a lot of money, and it is truly one of the real bargains. On the other hand, for people who this may be their first time to have money to play with.
Let me give you a great do-over strategy. You just gave a great example. Let's say we have a husband and wife, and the husband claims his benefits early at 62 just because he can. He's fine with that. He's taking a 25% haircut. It doesn't occur to him until later, wow, if I get less money now and I die first, my widow is going to have a smaller benefit. Is there anything I can do about it? Actually, you can. There are 2 do-over strategies. The first one is anyone can change their mind within the first 12 months of claiming Social Security benefits and withdraw their application for benefits. But there's a catch. If you withdraw your application, you have to pay back any of the benefits you have received, but it wipes the slate clean as if you never claimed benefits. So at a later date, when you're older, and it's as if you're claiming for the first time and get a bigger benefit. But that puts a lot of people off if you have to pay benefits back. Here's a second opportunity, but you have to wait till your full retirement age or later. At that point, you can suspend your benefits. It means any of those checks you've been receiving stop. But now they're going to start growing by 8% a year. So let me give you a mathematical example. That husband whose full retirement age benefit was $2,000 a month at 66, but he claims 4 years early at 62. He doesn't get that $2,000 a month. He gets $1,500. He took a 25% haircut. He collects that for 4 years. He gets to his full retirement age of 66, and now he suspends his benefit. Doesn't have to pay anything back. He starts earning delayed retirement credits, 32% over 4 years. If I multiply 75%, which is the amount he got at 62, times 1.32, those 4 years of delayed retirement credit, it comes out to 99%. He has effectively restored his full retirement age benefit by age 70. And if he dies first, that's the amount his widow's would get.
I love that math. That's
Paul, I think you're on mute.
You have another question?
I just to clarify a couple of things for this survivor benefit. Is the survivor benefit still in existence if the deceased spouse was on SSA disability?
Oh, I'm so glad you brought that up. Social Security is really 3 programs. We think of it as retirement primarily, but it is also disability if I am unable to work or terminally ill before full retirement age, and then it's a survivor benefit. For those people who qualify for Social Security disability benefits because they can no longer work, it's a case-by-case basis. It's not automatic like claiming retirement. And the delay for processing your application could be 2 or 3 years. It's a very long process. But if, let's say I am approved for Social Security benefits and say I'm 60 years old, I get disability, I'm effectively getting what would have been my full retirement age benefit, but instead of waiting till 66, I'm getting it at 60 because I'm disabled. and my checks say Social Security disability because it's coming out of the disability trust fund. When I reach my full retirement age, my checks are now going to say retirement because now it's coming out of the retirement trust fund, but the amount remains the same. And if I later die and I have a surviving spouse, that is the amount that will become my widow or widower's survivor benefit. And remember, at that point, their own smaller benefit goes away. So even in a best case scenario, a household Social Security income is going to drop anywhere from a third to a half when one spouse dies. Yes, the survivor benefit will continue, but that other smaller Social Security benefit goes away. So that's why it's so important when you're meeting with this financial advisor of saying, if I die first, what am I leaving my wife? In addition to my Social Security survivor benefit, does my IRA have a survivor benefit? Does my pension have a survivor benefit? Is there life insurance? You know, what do we do to protect them? Because even if I die, the household expenses probably aren't going to go down that much. We need income to continue.
Right. All right, another question, changing topic slightly. So if I'm married to a person who used to be a citizen of another country, is now an American citizen, has a work history in that other country, like New Zealand, say, and has a work history here in the United States, can that work history in a foreign country be factored into their Social Security equation?
It depends on what the country is. There's something called a totalization agreement. I'm not pronouncing that correctly. For example, maybe I worked 20 years in Canada and 25 in the US. Canada and the US have an agreement that we can combine our work years under the two systems to come up with one benefit under one of the systems. That is not a universal agreement. It's on a case-by-case basis, often in the case with Australia, New Zealand, a lot of the Western European countries. But let's say my spouse or I worked overseas and I have a pension from work in another country where I didn't pay Social Security benefits. It's just like I'm a school teacher in Texas or Louisiana or California. I didn't pay into the Social Security system because we have our own retirement system. The rules are different for getting the benefits out. There are two separate rules when it comes to people who receive pensions based on work where they didn't pay FICA taxes, whether it's from a state and local government or in some cases a foreign government. If I've worked in the US private sector long enough to be eligible for Social Security benefit, I have at least those 10 years of work or 40 credits, I'll get a Social Security benefit, but it's going to be reduced because I have this other pension based on work where I didn't pay FICA taxes. That's called the windfall elimination provision. Think windfall worker, I get a benefit, but it's reduced. There is a more onerous rule that affects people with these public pensions, maybe that Texas school teacher who never worked under Social Security and never planned to get a Social Security benefit, but her husband works for Dell Computer. She figures she'll get a spousal benefit. Maybe not, because there's this government pension offset rule, think GPO, grumpy partner. It says if you have a public pension based on work where you didn't pay FICA taxes, and now you try to claim Social Security as a spouse or a survivor, we are going to reduce any potential Social Security benefit by 2/3 of the amount of your pension with no dollar limit. So if you had a $6,000 teacher pension, 2/3 of that is $4,000. $4,000 subtracted from any potential Social Security benefit, go to wipe it out. So in those cases, I tell married couples where one of them is a public employee with one of these pensions, maybe this couple does not want to delay collecting Social Security for the private sector spouse, because the main reason you want to delay is to maximize the survivor benefit. And if your spouse can't get a survivor benefit, why wait?
Mm-hmm. That's great. So when somebody is nearing retirement, and when should they start or nearing the point at which they're going to file? At what point should they start the process? If you're wanting to file as soon as you're eligible, when should you start the process?
Well, first of all, the thought process, I'd say start at least 10 years in advance and really think this through. The other thing I want Americans to realize, that decision of when to retire and when to claim Social Security benefits are two separate decisions. They do not have to occur at the same time. You can retire at 62 if you want, and maybe still delay claiming Social Security to 70. And in between, maybe you're drawing down some of your 401k and your IRA as a way of buying yourself a bigger Social Security benefit later. But if you're saying, how far in advance do I physically need to apply for benefits? You can apply for your Social Security benefits 4 months, up to 4 months before you want those benefits to begin. And I encourage people to apply online. Again, Social Security field offices had been closed for 2.5 years. They have really improved the online application process. And frankly, the computers don't screw up. They recognize your birth year. They recognize your marital status. You just follow the prompts. You can do that if you're filing as a married person, requesting spousal benefits if you were born before 1954. If you're divorced, you can start the process online, but you're going to have to contact Social Security as far as handing over these documents proving that you were married at least 10 years before being divorced. And survivors need to contact Social Security directly. You cannot file for survivor benefits online.
Mary Beth, if someone has a question and they go to Google and write the question and put the name Mary Beth Franklin after the question, or investment news, Mary Beth Franklin after the question, are they likely to get your answer? Because
well,
it's
I say,
probably something.
Cut out the middleman. Go ahead and email to me directly at mbfranklin, that's Mary Beth Franklin, mbfranklin@investmentnews.com. I do try to answer every question I get. Please say you heard me on this program, that I was talking to Paul. I will say I have over 30,000 unanswered emails. I'm not making that up. But if you're at the top of my list, I answer hundreds a week. It's just if you get too far down in the queue, just send it again.
That's great. Well, you've been wonderful, and again, give us that that address, that URL to get your book.
Thank you. Everything I just talked about today, you can find in my ebook, and you go to www.maximizingsocialsecuritybenefits.com. You can also listen to my podcast, which is called The Retirement Repair Shop. Any place you listen, Spotify, Apple Podcasts, whatever, and listen carefully to the intro and outro music. It's original music by my son, DJ Throwdown.
That's great. And also this show will be housed both archived at BCF, Bainbridge Community Foundation, BainbridgeCF.org, and at paulmerriman.com. And so if folks who are watching today want to share it, I hope that they'll tell people. And we will be sending this out to all the people who decided to garden tonight instead. We had a little bit of sun, I think, and
you got to grab that sunshine while you can where you live.
That's right. You've been a jewel, and it is interesting. We had Larry Swedrow as our other special guest, two people who try to answer every email, every question they get, and that's a passion that we're happy that you have. Thank you.
And remember, your questions keep me sharp. It lets me know where the confusion lies so I can write more illuminating columns.
That's great. Jim, thank you too. And
thank
thanks
you both.
to DCF. They're wonderful, and we'll hopefully see you again. I hope you'll come back, Mary Beth.
I'd be delighted.
Okay.
Thank you, and safe travels.
Yeah, thanks
you.
Thanks,
everyone.
Bye-bye.
Bye.